Yes, people, a very happy with all of you. So, guys, we're going to start with a brand new chapter today, which is buyback of securities, which is your chapter number 12 of your ICI module. So, let's have a quick look at what are we going to learn from this topic. So, first, we'll try to understand what is the meaning of buyback. What is the meaning of securities? A buyback over. Next, securities. Next, what is the objective of buyback? What is the purpose of buyback? What is the advantages of buyback? Then we'll try to understand there are certain provisions of Companies Act 2013, which is section 68, 69, 70, which is coming into picture that we have to comply while doing the buyback. So what are the compliances? What are the provisions laid down in section 68, 69, 70, and how this is impacting the buyback is something we have to assess. The most important question is that thereafter, why this section has come into picture? If this section was not there, if these sections are not complied, what will be the impact and on whom the impact will happen is something which we have to discuss. Then we'll understand what is accounting treatment for the buyback and the process of buyback. The process of buyback elaborately again we'll discuss in law, but here we'll also skim through the process of buyback. And finally, there are small other topics that we have to discuss. So this is the whole and soul of this chapter. So can we start? Very sweet, simple topic, not very complicated. Buyback of securities. Buyback of securities. If I have to tell in simple language, what is the meaning of buyback? Is nothing but repayment of capital. What is it called as? Repayment of capital. Long ago, very long ago, once upon a time, when you're studying in 12th standard CA foundation, we studied that there's a form of business. Correct, no? Business has to be, be operated in any particular form or a body. So there are multiple forms in which the business can be operated. Sole proprietorship concern, partnership concern, companies. Remember? So companies we had. So when the company was formed, the company to run, it required funds. Correct, no? So funds can be raised for any companies using two sources. One is capital source. Second is borrowing source. That is, yes, debt. Correct, no? So here we're talking about the capital source. So please tell me, when the company was wanting to raise capital from the public, what it used to do? So it used to offer the shares to public. Public used to subscribe the shares of the company and they used to make the payment, application money, allotment money, call money, all of you recollect? Yes. So this is that company who is in need of funds. And for that purpose, it has issued equity shares to whom? General public. And these general public has what have they given in return to us? They've given money in return to us. So the company is getting money from the general public, and against that, what is the company doing? Company is issuing equity shares to the general public. Upon the issue of equity share, so this so-called general public are now called as shareholders, are also called as members, owners of the company. Correct? So we were talking about what type of capital. There are two types of capital. One is equity share capital. Second is preference share capital. So here we are talking about which capital? We are talking about equity share capital. Issue of equity share capital. So company has received money from the shareholders. So rather, it is public, and from that the company is issuing the equity shares, and upon issuing equity shares, this general public is now become the shareholders. Please tell me, when will you return as a company? When will you return back the money to the shareholders? Only at the time of winding up. That's right. Correct, no? So equity share capital can be returned by the company only at the time of winding up. But buyback, now we're talking about the repayment of the capital, where the companies now got the option to repay the capital. Which capital? Equity share capital, even before the wind up procedure. That is, even before the companies goes for winding up, they can repay the capital back. So what is the meaning of buyback? Buyback of security is nothing but the process of repayment of capital from the business. So in this case, what happens? The company which has got surplus money now, they'll give that surplus money back to the shareholder, and in return, what will be asked them? They will ask them to surrender the equity share certificate. Correct, no? Here, when the company took money from the public, the company in return had issued a document called as equity share certificate. Correct? No? Now, same way, when the company is asking to repay, sorry, when the company is wanting to, get the share certificate back, so what would you give as a company back to the shareholder? Money. So when you give money to the shareholders, in return, what will they surrender? They will surrender the equity share certificate. Now, what will you do with the equity share certificate that you have got? You will tear it. Means what? You are going to cancel the, yes, this is nothing but the cancellation of the equity shares that has been allotted earlier. So physical document, what you get back, you have to tear it, physically tear the share certificate within 7 days of completion of the buyback procedure. So when we discuss about the buyback procedure, we'll talk about how this has to be done. So in simple language, what is buyback? Buyback is repayment of the capital. Buyback is nothing but repayment of the capital. Wonderful. First point. So I've prepared the summary notes for all of you. Buyback of security means repayment of capital. That is the company purchases its own share. Buyback of security means purchasing of its own share. By whom? By the company, and cancellation of the certificate thereof. This is buyback. Any problem in the first line? No problem. Okay. Second, buyback is understood, sir. Buyback means what? Repayment of the capital. Buyback is a process of repaying the money back. What is the meaning of securities? They've not used the word shares here. What do they use? The word securities. Is security equal to share? No. Security includes equity share, preference share, and debentures. Security includes means what? Security is a very broad term. Under that we have equity, under that we have preference share, under that we have debentures also. So now the question is, in this chapter, what are we going to study? In this chapter, what are we going to study? Are we going to study about the buyback of all these three documents? The answer is no. We are going to study only the buyback of equity shares. Am I loud and clear? Buyback of preference share and buyback of debenture is not there in your syllabus. Sir, if buyback is repayment of capital, if buyback of preference share is repayment of capital, then what is that which we studied in CA Foundation, sir, which is called as redemption of preference share? Then what is the difference between buyback and redemption? In buyback, the company repays the capital before the due date of its repayment. Whereas in redemption of the company, sorry, in the redemption of preference share, whereas in redemption, the company repays the capital on the agreed due date. So all of you know that preference shares are redeemable preference share, which means when you are issuing the preference share, you should tell the preference shareholder on which date you're going to repay the money back. After how many years you're going to repay the money back. So on that agreed due date, if you repay that money back, that process is called as redemption of preference share. But sometimes the company's got the money, surplus money left over. So they don't know what to do. So they are like, why should I keep that money with me? Better I can call my preference shareholder, get the certificate from them, tear the certificate and give the money back. So if you are going to make the payment of the capital, rather if you're going to repay the money back to the preference shareholder before the due date, it is called as buyback. Redemption of equity share capital is never possible because while issuing the equity share capital, you have never promised on which date you will repay it back. Law very clearly said that equity share capital once issued can be only returned only during the winding up of the company. So redemption of equity share capital is never possible. Yes, buyback is possible. So what is buyback? Buyback is repayment of capital on an unplanned date. It's an unplanned event and activity. Today I have surplus money. I felt okay. Why should I, keep that money with me? Rather, I will repay the money back to the owners. So it is unplanned event, whereas redemption is a planned event. Redemption of preference share is a planned payment or planned repayment. Redemption can be planned, but buyback is not planned. It just happens when you have surplus money, when you have surplus reserves, you decide, okay, let's go ahead and repay the capital. So in buyback, the company repays the capital. In buyback, the company repays the capital before the due date of its repayment. Whereas in redemption, the company repays the capital on the agreed date. Redemption is possible only for preference share and debentures because when you issue preference share, when you issue debenture, you have to inform the preference shareholder, you have to inform the debenture holder that when are you going to repay the money back. So on that agreed date, if you repay the money back, that is called as redemption of preference share or redemption of debenture. So redemption is not possible for equity shares. Any problem? Debenture repaid on due date. is called as redemption of debenture. This is covered in your CA Foundation syllabus. Debenture repaid before the due date is called as buyback of debenture, which is not there in your syllabus. Preference share repaid on due date is called as redemption of preference share, which is governed by Section 55 of Companies Act 2013, which we already discussed in CA Foundation syllabus. Preference share repaid before due date. Before due date is called as buyback of preference share, which is governed by Section 68 to Section 70, which is not there in your CA syllabus. Not there in your syllabus. Equity shares repaid before due date. Equity share repaid before the due date. Any payment done before the due date is buyback. So buyback of equity share, which is governed by Section 68 to Section 70, is now covered in your CA inter syllabus. So all the questions that we are going to solve in this chapter is from the point of view of equity shares bought back. Any problem so far? Online people, any problem so far?
No, sir.
Chalo, let's go to the fifth point. Sir, buyback results in decrease in the share capital of the company. Correct? My simple question to all of you. Let's say this is a company who's issued 1 lakh shares of rupees 10 each. Could you please tell me what is the journal entry for issue of share capital? Very good. Bank account debit to equity share capital. 1 lakh shares have been issued at the rate of 10 rupee per share. So how much it is? 10 lakh and 10 lakh. So if I open the balance sheet, let's say the old format, just for understanding purposes. So in the bank, you'll have 10 lakh. In the capital, you have 10 lakh rupees. This is the position of the balance sheet after this entry. This is called as issue of capital, issue of equity share capital. In buyback, what happens? Very simple. Whatever entry of past, this entry you have to reverse. So what is the reversal entry? Equity share capital account debit to bank. Equity share capital account debit to bank. So let's say out of this, I am repaying 20,000 shares back. I'm buybacking 20,000 shares. So 20,000 shares into 10. How much it is? 2 lakh and 2 lakh. Now please tell me, after this entry, if I prepare the revised balance sheet, my bank, in the bank, how much money is left over? 10 minus 2, which is 8 lakh. And equity share capital 10 lakh minus 2 lakh, 8 lakh. So now, if I come back and read this line one more time, buyback results in decrease in share capital of the company. Any problem? So earlier the capital was 10 lakh, and from 10 lakh, now it has become to 8 lakh rupees. Very simple. But how easily have passed this entry? That easily. If the entry could have been passed, then this chapter would have come where in foundation itself. So now there's a lot of drama that is going to happen. This is not going to happen. This is the ultimate impact. But this will not happen that easily. There's a lot of masala that is going to happen. There's a lot of drama that is going to happen. Then finally this impact will appear. Am I loud and clear? So what is that drama is what we're going to see in the next 5 to 7 classes. Now, sixth point says that a company cannot buy its own shares for the purpose of investment. Since I have more money, I don't know where to invest. So I'll invest in my own company. So I'll pay extra money and get the money from the equity shareholders. That you cannot do. That cannot be the motive of you issuing buying back the equity shares. A company cannot buy back its own share for the purpose of investment. Now, all this theory why I'm reading is because all of you know in your syllabus, 30 marks is for MCQ. So highest probability of MCQ question being drafted from these questions. That's why each and every theory point I'm discussing in detail. Okay. Now, sir, first 6 point, do you have any doubts? Sir, first 6 points you're clear? Okay. Now, 7th point, sir, what is the objective or the advantage of the buyback? What is the objective and the advantage of the buyback? The first one is to increase the promoter's holding. That is to strengthen their holding. So this you can understand through a practical question. So for that, I've drafted a practical question. Can we see that? Example 1. It says that ABC Limited had issued 1 lakh equity shares of rupees 10 each. ABC Limited company has issued 1 lakh equity shares of 10 each. The managing director, that is the promoter of the company, the managing director, who is the promoter of the company, was holding 20,000 equity shares, and the remaining 80,000 equity shares were held by the general public. Correct? What is the company's name? ABC Limited. Has issued how many shares? 1 lakh shares. Face value how much? 10 each. So what is the total capital? 10 lakh. In that, how many people, how many category of people are holding the shares? Two category. One is promoter category. Second is general public category. How much shares is the promoter is holding? 20,000 out of 1 lakh. And remaining 80,000 equity shares are held by general public. Wonderful. The company bought back 20,000 shares from the public in order to increase their control. What this is, we'll understand. Case 1. So once the company bought back this 20,000 shares, you have to tell me what is the revised shareholding of the managing director after the buyback. What is the revised shareholding of the managing director after the buyback? So case 1, can we see? So now the solution is, you have to first tell me what is the percentage of holding before buyback. So managing director is holding 20,000 shares out of 1 lakh. So how do I get the percentage? So 20,000 upon 1 lakh if I do into 100, I'll get 20 percentage. So 20% shares of the company is held by the promoter and remaining 80% shares are held by the general public. So these are called as percentage of holding. So promoter is holding how much percentage of share? 20 percentage, and the public is holding 80% of the share. Together it is 100 percentage. Now please tell me, what is the journal entry? What is the journal entry? We have not studied the actual journal entry of this topic from a layman perspective. Correct? No? When we studied in 11th, 12th and foundation, when the capital is repaid back, what was the entry? Normally, forget equity. In the case of partnership and sole proprietorship concern, when the capital is withdrawn from the business, it is capital to bank. Same thing, no? Capital to bank. So I'm thinking from the layman point of view. I'm trying to explain from the layman point of view. I'm not trying to teach you buyback yet. So now 20,000 shares are bought back at the rate of 10 each. So capital account debit to bank 2 lakh and 2 lakh. My question goes to all of you. The percentage of the holding of these both, will it be same 20% and 80%, or will this undergo a change? Are you sure? If it is undergoing a change, then what is the revised holding? Please calculate. I'll give you 1 minute of time. Please calculate. Okay, others. I got the answer from few offline people. Buyback means what? The process of cancellation of the shares. Cancellation of the share means what? I'm paying this 2 lakh rupees to general public. I'm paying this 2 lakh rupees to general public. In return, what are they giving me? They're giving me a share certificate, which I'll tear and throw away. So now tell me, what is the total number of shares of the company now? Still 10 lakh, or it is reduced to 8 lakh? Still 1 lakh shares or reduced to 80,000 shares? Yes. So now the number of shares from 1 lakh all the way, it is now reduced to 80,000. You have cancelled the shares. Some people have doubt. So this 20,000 shares, what you took back, where did that share go? I am telling you, we have torn it. Gone. Swaha. Where will you go and search after that? Correct? No. We have cancelled, boss. We have repaid. We had surplus money. We repaid the money back to the shareholder and we have cancelled the capital. Now, by that virtue, what is the remaining shares in my hand? 80,000. Authorized share. Let's suppose authorized share here is 1 lakh. Here also the authorized is still going to be 1 lakh only. But we have reduced the number of issued share. So here 1 lakh share was authorized. Issued was how much? 1 lakh. Here 1 lakh share is authorized. Issued was originally 1 lakh, but in that 20,000 is bought back. So what is the remaining now? 80,000 shares. 80,000 shares. So now we have to calculate the revised percentage of holding after buyback. So now 20,000 shares upon 80,000 into 100. So if I multiply this, what will I get? 25 percentage is the percentage of holding. So the percentage of holding of the promoter is going up due to buyback, and from whom we have bought back, that person's holding is going down. So here, if you noted, the MDs, that is promoter stake in the company, automatically increases upon the buyback, even though the buyback payment was made by the company through the company's account. For increasing his stake, guys, please understand, promoters holding from 20% it went to 25%. Did he buy any share? The two ways in which he can increase his share. If he wants to increase his holding, he has to buy from the public. But here, did he make the purchase, personally? No. He routed that through company. So he made the payment go through company, thereby increasing his shares in the company, increasing his controlling shares of the company, and therefore he can do effective management. Can you please tell me, why did this promoter do this buyback? Why did he want to increase his control, and why did he want to strengthen his control? Please tell me. Very good. Others, online people, please respond. Sir, why buyback? With this, why buyback? If I want to ask you, what did you understand and why buyback? I'm asking you now. Okay. Tell me. Think, scratch. Why was here the management and the managing director or the promoter very particular to increase his shares? And why do we call this as strengthening of control? Why do we call increase as a control in share? Why?
20% of shares does not give
Okay. Not exactly. So basically what happened is, all of you know that equity shareholder has got one right. What is that right? Voting rights. Correct, no? Let's suppose KVA Limited 50% stake with me. 50% stake with Pratik Sir, SPJ. And remaining 50% is there with Anita ma'am, for example. So who are the 100% controller of the company? Both of us put together is SPJ plus Anita ma'am. Okay. Which means who has contributed to the capital of KVA Limited? These both people only have contributed. So what happens as the company grows? The company wants to open multiple branches. So what happens? They are in need of more capital. So what happens? The value of the business increases. Thereby, you would want to dilute your share. And a part of this, I want to give it to public at a higher price so that I can have more liquidity, more money coming into the business. Correct? No? So now what happened? By that virtue, 25% and 26% of SPJ share and Anita ma'am share is being given to general public so that we can raise funds from the public. So please tell me, by that virtue, how much shareholding is remaining with SPJ? 25 percentage. And how much is with Anita ma'am? 24 percentage. And how much with general public now? 51% stake. So 25 plus 24 plus 51 if I add 100 percentage. Imagine these general public are the close, near and dear ones. Rather, instead of telling general public, if I say this is one of the close investors, to one of the close investors, I've given 51% stake. Correct? So this person has provided us a humongous capital that is required to expand the business from where we are now. And for that purpose, for raising that much fund, we had to give 51% stake of our company to that particular investor. Correct? No? Now, this investor, as long as the investor is under control of SPJ and Anita ma'am, we have no problem. But imagine after a few years, this investor is now in the plan of selling his entire 51% stake to somebody else. Let's say the company is grown now, 5 years, 10 years. This investor has made his money. This investor has made his money. Now he wants to exit. Because what is the ultimate motive of any investor? He'll invest the money in startup. Once the startup is growing, the valuation is coming out well, he will sell his stake and go and invest in some other startup. That is how it works, right? So now the company is grown good enough and the investor want to sell his stake. Now, what will happen if this fellow sells his stake? Who will have fear in the minds now? SPJ and Anita will have fear in their mind. What fear should be running in our mind? As long as anyways, we lost 51% stake to the investor, means control was still not there. But this person, despite holding the 51% stake, was a close investor who would listen to everything what we say. So still we didn't have any fear. Now the fear that we have in our mind is if this investor is selling his stake to somebody else for the greed of money, and if that person is, let's say, the competitor of my business, then what will happen? If the competitor is buying 51% stake in my company, very soon he will kick us out of the company. Correct? Because 51% is what? Major shareholding, stakeholding. Major voting right is with them. So these two people will be under threat and risk. Correct? No? So therefore, the concept where you said, no, sir, equity share capital can be only repaid in the event of winding up. If I wait till winding up, forget, these both people will lose their existence in the company. So companies that had to come out and safeguard the interest of these promoters. Hence, the concept of buyback was introduced. So now when I do the buyback, what do I tell this person? That I will buy back your shares. There's a limit. The limit that has been given is 25% is the maximum buyback they can do. Out of 100%, maximum shares that you can buy back or the shares can be bought back is 25%, which I'll be discussing in the upcoming session. So now we are telling that whatever money you want, you tell us. We'll pay that money to you because we want to increase the controlling shares. We want to get the share certificate back. I want to tear it. So when I tear it, automatically our control in the company will increase. We saw how it increases. So this is the ultimate objective of buyback. So coming to the point here, objective or the advantage of buyback is basically to increase the promoters holding. When the promoters holding increase because of the buyback, their shareholding strengthens. Their voting rights in the company increases. Thereby, they can have the maximum control of the company in the decision making. That is the first and the foremost purpose of buyback. Do you have any problems in this? Online people, do you have any problem in this? So here the promoter has increased the stake in the company from 20% to 25%. 20 to 25 is not very significant. Here, for example purpose, I took it. But here the promoter has taken what? Increase of his controlling shares by the buyback through the company. The controlling shares of the promoter holdings for effective management of the business. This prevents the hostile takeover of the outsiders. Correct? No? What is the meaning of hostile takeover? Hostile takeover means silently somebody coming and ripping you apart. That is called as hostile takeover. Imagine this company has got 80% stake in the public. Imagine this is a case of Reliance Limited. The managing director of the Reliance Limited is holding 20% stake and the 80% stake is held by general public. Correct? No? Imagine the competitor of Reliance Limited, let's say Adani, gradually, without the knowledge of the MD or the promoter of the Reliance Limited, if he starts buying the shares from the market slowly, from where share market, correct? No? It's like that. Gradually, if this person start taking the share from the market, Adani gradually takes this from the public. What happens? After a point of time, 80% of the stake from the public will go to whom? Adani Group. So now Adani will be holding major share and Reliance Limited MD will be kicked out of his own company. Can you pose that threat or not? So hostile takeover, this is called as hostile takeover. Gradually, when Adani started accumulating the shares under different companies by different names, nobody will get to know. Adani will not come and take the shares under one name. Give all the 80,000 shares to me. No. He will try to get little by little in different names. And these different people are all under the control of Adani. So this is called as hostile takeover. Slowly you are venturing into the company without the knowledge of the company and taking the controlling shares fully. 80% shares if you are controlling as owner, then what happens? This managing director, even though he's a promoter, he's got no control on the company because he's got only 20% voting rights. Your voting right is dependent on the percentage of your holding. If 20% is your holding, then your voting right also 20%. So to prevent hostile takeover, buyback was permitted by Companies Act 2013. So coming back, to avoid hostile takeover, that is to avoid the takeover by others, that is competitors, the buyback was promoted by Companies Act 2013. Any problem in this? Second, to increase the earning per share of the company. If the company wanted to increase the earning per share, then buyback was another option. How, sir? Same example one. Let's go back. Here I've given a case too. Same case where ABC Limited issued 1 lakh equity share of 10 each. Managing director was holding 20,000 shares and remaining with public. 20,000 shares bought back. Okay. Calculate the EPS before and after buyback. If the profit available to equity shareholders, that is profit available for distribution to equity shareholders, how much? 40 lakh. 40 lakh is the divisible profit available to equity shareholder. Please tell me, what is earning per share? 40 lakh divided by, before buyback, how many shares? How many equity shares? 1 lakh shares. So how much is the EPS? 40 per share. Means for every 1 share I purchased, 40 rupees is my earning per year. For this year, what is my earning? 40 rupees per share is my earning. Now, when the buyback is done, same 40 lakh is the profit, let's suppose. Divisible profit. Now you'll divide by how many shares? 80,000 shares. Now how much is your EPS? 50 rupees per share. So with this, what do you understand? When we do the buyback, the quantity of the shares reduces, thereby the earning per share of the shareholder increases. This is the example for that. Earning per share before buyback 40 per share. Earning per share after buyback. This is after buyback 50 per share. So to ensure or in order to increase earning per share of the members, the company opts for buyback. The company opts for buyback. Any problem in this? Online people, any problem in this?
No, sir.
Online people, are you all there?
Yes, sir.
Okay. So first objective done, second done, third done. Fourth one is what? To put unused surplus cash to use. So why buyback? The company is having huge surplus, humongous surplus. What to do with that surplus? So if I have a lot of capital, see, why did I go to public for raising the money? Because I didn't have capital at that point of time. Now, over a period of 5 years, you have done excellent business. I have a lot of surplus with me. So now still, do I need to have the shareholders with me and give the dividend to them? Instead, I can buy back the shares. I will increase my control. My voting right will be increased. My earning per share will be increased. My dividend will be increased. So what a surplus money is that instead of keeping that money idle in the business, you can consider to buy back your shares. So to put unused surplus cash to use, a company having sufficient cash may decide to buy back its own share. Means now whatever question that we're going to do, whatever question that we are practically going to see, it is of those companies who's got surplus money left in the reserves and P&L. With that extra money only, we're going to do the buyback. We're not going to discuss about any case which does not have the money at all. Still, they want to do buyback. Arey Baba, when you don't have the money left over with you, how can you do buyback? So buyback means it is done by those companies which has got surplus money in their reserves. Any problem? Good amount of MCQ questions are possible here. Be very, very careful. Yes, boss. I'm coming to that point. Now, to leave a positive impact in the stock market. So now, why what do you call it? Buyback. Another objective of buyback, to leave a positive impact in the stock market by supporting the share price. Now listen to me very carefully. This is in line to what he asked. What question he asked Balaji? Balaji is asking, sir, you want to buy back the share. What if the opposite person doesn't want to sell his shares? If he is not willing to surrender his shares, if he is not willing to sell his shares, how will you buy it from him? Correct? No? Now, there's something called as face value of the shares. All of you know? Okay. There's something called as market value of the share. What is market value of the share? If the shares are listed on the stock exchange, this shares will be traded at the market value. So let's say the market value of the share is 100 rupees. Face value is 10 rupees. So if I tell the shareholder, give me the share back, I'll give you 100 rupees. He will say, get lost donkey fellow. Why should I give the shares to you? If I go and give the shares to anybody in the market, they'll give me 100 rupees. So if I go and offer 100 rupees, which is at par the market value, no seller will give me the shares. So definitely the buyback price has to be more than, yes, the buyback price has to be more than the market value. So here the company might choose to offer 150 rupees per share. This rate should be that much attractive that the shareholder should think that even if I wait for 1 year, the share price is not going to increase at 150. It can maximum go to 125 or 130. When this company is offering at 150. So what is advantage for me? Selling the shares to the company itself is advantage because I am not. See, do I am the shareholder of Reliance Limited? Do I call myself as owner? Do I have any attachment to the company? No, I am here in the company only to make the money in the share market. That's all. No? So whether I make money here or whether I make money here, how does it matter? At the end, what is important? To make money is more important. Correct? No, that is the intention of any shareholder. Am I loud and clear? So here, whenever the company intends to buy back, the buyback price has to be more than market value. Only then it will attract the investors. I mean, it will attract the retail investors to surrender their shares. So now, why this has a positive impact in the stock market? Why will this have a positive impact in the stock market? Positive impact means what? Now the share price of this company will go up upon buyback. What am I talking about? Why are we doing buyback? Buyback will have a positive impact in the stock market. Positive impact in stock market means what? The share price of that particular company should go up. That is the meaning of positive impact. So now what happens when everybody comes to know that this company whose current market value is 100 is going to buy back at 150, everybody will start buying the shares of the company. Correct? When the buyback is announced today, immediately tomorrow buyback will not happen. There's a buyback procedure. You'll give them some amount of time. So during that process, when people hear about this offer, a lot more people want to buy the shares of this company. So automatically, when there are more people to come and buy the shares of the company, what happens? A lot of demand creates. In economics, we have learned that when there's too much of demand for a particular product in the market, what is the price of that product? The price will also increase. So market value also might increase beyond the expected level. So thereby, this leaves a very positive impact. So some people to create a very good momentum in the share market. Some shares, they don't have a momentum for a long period. There's some shares in the market today, their momentum of the shares, that is the up and down of the share, the price range of the share, hardly 10, 15 rupees up and down it's happening. It's been 2, 3 years. So now they want to give a momentum to the share. So they have to create some information in the market so that there's a huge variation coming into picture. So buyback at times used as a triggering tool to trigger your share prices in the market. Any problem with this? So in general, the buyback price is more than the market price of the share, therefore attracting more retail investors. So if there's more demand for that share in the market, ultimately the share price of the market goes high. That is share price of that particular company goes high. Next, when promoters increase their holding, it highlights how strong the financial of the company is. Please understand, buyback means what? The company is trying to buy back their own shares from the existing shareholder, which means what? How much money they should have in their pocket. Only the company just got strong reserves and surplus, intends or thinks about buying back. So the company is executing buyback. Imagine how much money will be there in the bank balance. Correct? So that gives you credibility that, okay, if this person is buying the shares back, if he's increasing his stake in the company, then this company is on the right track. They're doing very good business and this business is giving great profits. So if I am associated with this company, if I am associated with the company, if I take the shares of this company now, what happens? I will also benefit from the future profits of the company. Please understand, buyback means what? One part is the company is taking the shares, tearing it apart. That is one process. But they're not taking all the shares from the public. No? If little bit of shares are taken from the public, the other part of the shares are with the public only. No? If you take this example, how many shares did you buy back? Out of 80,000 shares, 20,000 shares you bought back. Remaining 60,000 shares are there in the market only. No, boss. So now these 60,000 shares has to be circulated in the share market. Now, I have a feeling that if this company is doing a buyback, if it has got so much of money, how did it get so much money? Because they did excellent business. So which means if they continue to do the same business in future also, the price of the share which is today, maybe 2 years down the line, it could be double. So like that, I might think and I might invest in this company. So that is the advantage of buyback. The other stakeholders who are still continuing in the business of the company, that is continuing as a shareholder, they have a positivity that, okay, this company has got a bright future. Their financials are very strong. So let's further invest in this company. So now when I'm holding, let's say out of 60,000 share, if I'm holding 500 shares of this company, after the buyback information, I will be tempted to buy, let's say 500 more share or 1,000 more share from the remaining stakeholders. So that is one positivity for the shareholders. One second, Kamam. Okay. Till this, you have any doubts, please ask me. Yes.
So what if the company doesn't have surplus, but since the holding control is going out of hand, they take a loan or something to do that?
Okay, very good. Now the question that has been asked is, sir, the company does not have reserves and surplus, too much reserves and surplus, but the company is fearing hostile takeover. The company is fearing the hostile takeover. But the company does not have reserves and surplus. Can the company take loan? Can the company take loan and buy back its shares? For that, you have to wait for some more time. There is an answer to it, but that will be discussed when the theory part of that section comes. This will be discussed about. But yes, this is also a very good situation where the company does not have reserves and surplus, because I said what in the beginning, we are talking about only those. I mean, the practical question that we are going to see now in the CA intermediate level is that of those companies who has got a lot of reserves and surplus, and from that reserves and surplus, they are trying to buy back the shares so that the controlling shares can be increased. Now we're talking about those scenarios where the reserves and surplus is not there. So can the company go for, fundraising in a way where the hostile takeover can be prevented? The answer is yes, it is possible. Now, how it is possible, we'll be discussing in the upcoming sessions. In fact, if possible, in today's scenario itself, we might even discuss a practical question based on this also. Now, next objective and advantage of buyback: to improve capital-based accounting ratios, debt equity ratio, total asset to debt ratio, right? Now, capital-based ratio I'm talking about, debt equity ratio. To improve the capital-based ratio, some companies may opt for buyback. Any problem in this? Any problem in this? Okay. Let's go to point number 8. A company intending to buy back. A company intending to buy back its equity shares has to comply with all the provisions of Section 68, 69, 70 of the Companies Act 2013, or else it will have adverse effect on the trust or the security of the external liability holders of the company. Now, very simple. Let's come back. Let's come back to example 2. This is a balance sheet of XYZ Limited, where you can see on the liability side, we have equity share capital of 10 lakh, which means 1 lakh shares of rupees 10 each. We have free reserves 2 lakh, and we have external liabilities 5 lakh. Correct? And the money which is there in the bank 17 lakh, let's say all the asset is nothing but bank balance 17 lakh rupees. Okay. The company decides to buy back 20,000 equity shares of rupees 10 each. How many shares? 20,000 equity shares of rupees 10 each. Case 1, ascertain the security of the external liability holders before and after the buyback if Section 68 compliance is not adhered to. What am I asking? I'm trying to understand what is the security of the external liability holders. All of you know that when the company wounds up, there's an order in which you have to repay the money back. Correct? No? Let's say if this company is winding up, you have the 17 lakh rupees with you, right? You have to make the payment in a particular order. In which order will you make the payment? So first, I will have to make the payment to external liability holders. We've discussed this in foundation. One more time, I'm discussing. First, we'll repay the money back to external liability holders. Once we settle all the money to external liability holders, second, we'll settle the preference share capital to the preference shareholder. After that, if any surplus money is left over, you will pay to the equity shareholders entirely. This is the order that the Companies Act has given. But now what are you doing? Now you are violating the Companies Act. You are violating this norm where you are making the payment to equity shareholder. Sir, how, sir? Arey Baba, what is the meaning of buyback? Buyback is what? Repayment of capital. So you are now not paying the first person, nor even the second person, directly the third person you are paying. Is it not the violation of the Companies Act 2013? So because of the buyback, who is getting upset here? Who is getting a feeling of unsecuredness or insecurity? External liability holders. So who will now start crying? Correct? And if buyback is not done, hostile takeover is possible. The competitors can take over the shares of my company and the promoters could be kicked out. So there, if the buyback is not done, who will end up crying? Promoters will end up crying. So now, it was the responsibility of the Companies Act 2013 to come out with in-between path where neither the external shareholders, external liability holders are affected because of this buyback process. At the same time, the buyback can be proceeded by the company to prevent the hostile takeover. That is how Section 68, 69 and 70 come into picture. The job and the purpose of 68, 69 and 70 is to ensure that the external liability holders do not feel any pinch or insecurity, and at the same time, the company can go ahead and do the repayment procedure so that the hostile takeover could be prevented. Am I clear? Now please tell me. Here, before the buyback, how much of money is secured for external liability holders? What is the security of the external liability holders? So whatever money is there in the bank, 17 lakh rupees. Whatever money is there, 17 lakh rupees. In that, 2 lakh rupees I will minus. Correct? Guys, free reserves. What is free reserves? Free reserves are those reserves which the company can give as dividend to the shareholders. And nobody can question about it. Correct? No? Which means if the company is winding up 17 lakh rupees, and out of this, if the company wants to give 2 lakh rupees as dividend to equity shareholders, the external liability holders cannot stop. Forget winding up. Let's say the company is going very smoothly. Everything is going smooth. Nothing to worry about. Now the company has decided to give the entire free reserve as dividend. Can be given. subject to the condition what we discussed in Schedule 3. In Schedule 3, we have agreed that if you want to give anything from the past profits, we can give it subject to the terms and condition. But can I say this is available for distribution as dividend freely? Yes or no? So even if the company was not winding up, even if the company was not doing the buyback, out of 17 lakh rupees, anyways, the external liability holders did not have the control on the 2 lakh rupees. So on the remaining money, 15 lakh rupees only, anyways, the external liability holders had a control, no? Even when the buyback was not done, even if the company was not winding up, everything is going smooth. The company is running smoothly. Even now, if external liability wants to attack, how much money they can attack? Only 15 lakh rupees. Correct? So now I'm telling that out of 17 lakh rupees, 2 lakh rupees is the free reserve for the equity shareholders. So how much money is there available for the equity external liability holders? 15 lakh rupees divided by 5 lakh. What is 5 lakh? External liability holders value 5 lakh rupees. So I'll get 3 times. What ratio this is? We've studied in 12th standard. This is called as total asset to debt ratio. Total asset to debt ratio means what? This 5 lakh rupees, what the liability holders gave me the money. I have so much money in the business. The company's got so much money in the business that this 5 lakh could be covered, protected how many times? 3 times. This 5 lakh rupees, which is there of the external liability holders, my safety margin is there how much? My safety margin is 3 times. Means this 5 lakh rupees, it is not getting protected once. It is getting protected twice and thrice. That much money is there. Are you able to follow? So more the total asset to debt ratio, the safer who will feel, external liability holder will feel, the safer he will feel. Now what is happening? Now you're doing a buyback. How much of the shares are bought back? 20,000 equity shares are bought back. And what are you doing? You are not complying with section 68, 69 and 70. More specifically, 68 you are not complying with. What is 68? I have not told you. 68 is not complied with. Just remember. Now you're doing the buyback. Means what? Equity share capital account debit, 2 bank, 2 lakh and 2 lakh. Correct? No, capital to bank. After this, if I prepare the revised balance sheet after the buyback, that is the balance sheet after the buyback, can I say capital from 10 lakh, if 2 lakh is gone, how much it is? 8 lakh. Free reserve, we didn't even touch in the entry. So it will remain as it is. External liabilities as it is. In bank, we had 17 lakh rupees, 2 lakh we have repaid. How much it is? 15 lakh. Now, can you please calculate the revised security of the external liability holders? Do it fast. You have to calculate the security of the external liability holders. Okay, I got answer. 2.6. How did you get it? 15 lakh again minus 2 lakh, sir. From this again 2 lakh dividend can be distributed. So how much it is? 13 lakh by 5 lakh. How much it is? 2.6. Which means because of not complying with section 68, the security of the external liability holders got reduced. Now they will start fearing. The fear is that, oh shit, something is wrong with the company. The company is giving the money back to the owners slightly. Inside gap, what are they doing? The owners are taking the money and going away. Why are the owners taking the money? Something is fishy. Now this external liability holders, let's say the creditor of the company, will think 100 times before he gives the goods on credit to you next time. And like that, if the creditors and the lenders, everybody start doubting the company, will the company be able to do the business? And that too, the motto of the company was not this. The company is doing well only. That is why it is doing buyback. Why is the company doing buyback? It has got extra money. They want to buy back the shares. It's okay. Everything is good. But because of your steps, what you followed, this person is now under fear. Fear that my security earlier, where I was getting 3 times security, now I'm getting only 2.6 times security. Why are the shareholders taking the money away from the company? Something is wrong in the company. Oh, maybe after 2 years, the company will slowly wind up. Then whatever money I gave now will not come back to me. Like that, a fear is getting created in the minds of the external liability holders. Am I loud and clear? So now, is it not the responsibility of the companies that to come and intervene? Because if the buyback is done, who is crying? Sorry, ulta I put. This become happy tears. Sad tears. Who is this person crying if the buyback is done without complying 68? External liability holders. If buyback is stopped, in order to please him, if I stop the buyback, hostile takeover is possible. In that case, who will suffer? Promoters will suffer. So now we have to come in between path. We have to come out with the in between path where the external liability holders does not feel any pinch. At the same time, buyback is done so that the hostile takeover could be prevented. So now what does section 68 saying? What is section 68 saying? As per section 68, after the buyback of the equity shares, after the buyback is completed, you have to ensure that the capital that was there before buyback, should be equal to the capital after buyback. Whatever capital was there before buyback, if the capital before buyback was 10 lakh, after buyback also it should be same 10 lakh rupees. If it is reducing, who will start crying? External liability holders start crying. So now the question is, sir, how, sir? 10 lakh means 2 lakh gone, again 2 lakh coming, then what is the purpose of buyback? So section 68 is come out with multiple suggestions. Now listen to me very carefully. As per section 68, after buyback of the equity share, the capital before buyback, which is 10 lakh, shall be equal to the capital after buyback, so that the trust of the external liability holders is retained on the company. So that the trust of the external liability holders is retained on the company. So how to keep the total capital intact as per section 68? So what is 68? Let's come to 8 point here. 8 point here. A company intending to buy back its equity share, a company who wants to buy back its equity share has to comply with all the provision of 68, 69, 70s of Companies Act 2013. If you don't comply, what will happen? It will have adverse effect on the trust of the security. Trust or the security of the external liability holders of the company. Correct? No? So what happened in the previous question? If I come back here, you did the buyback. In case one, you did the buyback, but you did not comply with the section 68. So the security of the external liability holders from 3, it came to 2.6. In order to prevent this, you have to follow section 68. So what does section 68 says? First option given by section 68 is that you can repay the equity share capital back if you don't have the surplus money. If you don't have your own funds, then you can issue the preference share. You can issue the preference share. How much preference share? How much face value of the equity shares you're going to buy back? No, whatever is the face value of the equity shares that you're going to buy back, equal to that, you have the option to issue preference share. When? If I don't have surplus money. So big share, if I don't have surplus money, I can issue preference share in place of using my own fund. Instead of using my own fund, I can issue preference share. From that money, I can do the buyback. So please tell me, when I issue the preference share, will I issue the preference share to any Tom, Dick and Harry, or will I issue the preference share to that person whom I trust? I will issue the shares of my company to that person whom I trust. So preference share, and anyways, preference share does not have the voting right. So I'm not bothered about that also. But with this money, what I can do, I can get the controlling shares back and I can prevent the hostile takeover. So this is one option. This we discussed where in the CA foundation when we did redemption of preference share. At that time, what did you issue? Equity shares. Now, when you're repaying equity capital, which shares are you issuing? Preference share. So you might have a question, sir, why can't we issue equity share capital itself for repaying equity share capital? What is the point? 10 lakh is equity capital. You took 2 lakh from one public and you're giving 2 lakh to another public. In that way, what controlling shares have you issued? So 68 is very clearly said that whatever class of equity share capital you're repaying back, for the same class or same kind of shares cannot be issued. So for equity shares repayment, you cannot issue equity shares. So what shares you can issue? Only option is preference shares. Am I loud and clear? Online people, am I loud and clear? This is one option. Some people are so rich that like, I don't need preference shares. I have so much of money with me. So what I do is, whatever money is there in the free reserves, I will transfer that to CRR. What is CRR standing for? Capital Redemption Reserve. So can we see this? Let's speak about the option number 1. First method. In first method, the total capital before redemption. Let's have a look at it. This is the balance sheet of KVA Limited. Equity share capital is how much? 200 rupees. Now, the company bought back equity share capital worth 50 rupees. And for this purpose, they need fund. And for that, the company has issued preference share capital of the same value. So can you please tell me, for issuing the preference share capital, what entry did the company pass? Very good. Bank account debit 50 rupees to preference share capital 50 rupees. Correct? And now I got the money. After this, what will I do? I will repay the equity share capital back. So what is the entry? Equity share capital account debit to bank 50 and 50. Correct? Now can we have a look at the revised balance sheet? In the revised balance sheet, where my equity capital was earlier 200, after buybacking 50 rupees, my equity share capital left is how much? 150. Imagine had you not issued the preference share, the capital before buyback was 200 and now capital after buyback would have been only 150. So if the capital reduces, the security of the external liability holders reduces. The fear of the external liability holders will increase. The trust of the external liability holders on the company will reduce, will get affected. So therefore, what happened? If one capital we removed and we inserted another capital. So thereby, the trust of the external liability holders are maintained. So now, by issuing preference share capital, your capital base is increased by 50 rupees. Thereby, now the capital base is same as that of before. Correct? No? So now come back to the same point. Section 68 says what? After buyback of the equity shares, the capital before buyback, in our example, was how much now? 200. Very good. Should be equal to the capital after buyback, which is 200. Before buyback, this 200 was only equity share capital. But after buyback, it became 150 for equity share capital and 50 for preference share capital. So this process ensured that the trust what the external liability holders had kept on us, that trust is being retained. In this, do you have any problem? Online people, in this, do you have any problem?
No, sir.
No, sir.
And for keeping the capital intact, to gain the trust or to safeguard the interest of the external liability holders of the company. Because as per the Companies Act, external liability holders are the first person to be paid and equity are the last person to be paid. But because of buyback, what happened? He's being paid first now, which is in violation of Companies Act. So now Companies Act had to insert another section in such a way that the buyback happens so that the hostile takeover could be prevented. And at the same time, the external liability holders promise by the Companies Act that I will ensure that you are paid first. That promise also is being kept by the Companies Act. Hence, Section 68 was introduced. Any problem? Online people, any problem?
No, sir.
No response. Okay, loud response from offline people. Any problem?
No, sir.
Now, same example two. Balance sheet of XYZ Limited. Equity share capital 10 lakhs. Sir, what are you trying to do? I am trying to set a base. In the very first class, I can directly tell, I say question 1, let's solve it. But without explaining the concept, why this journal entry is coming, if I don't set a base, if I don't, give a momentum to you, doing the question directly will not make sense. Doing the question directly, I'm telling you, even if I don't explain this concept, no, if I make you by heart the entries, 100% you'll get the full mark for this chapter. But what is the point when you do something without understanding what you're doing? So I'm trying to set a momentum, set a base for it. Small base examples before we go and tackle the big questions. Are you able to understand what is the approach here? The same approach we followed for Schedule 3 also. We understood the concept independently for each and every notes and then we comprised in the big full-fledged question. Same thing I'm going to do now. So this is the balance sheet of XYZ Limited. Equity share capital is how much? 10 lakh. 1 lakh of 10 each. Free reserves 2 lakh, external liabilities 5 lakh, bank balance 17 lakh. Now the company decided to buy back 20,000 equity shares of 10 each. Why I'm not making you write all this is because this is already there in the notes. If you just observe and put in your mind, load in your mind, more than sufficient. Whatever point is there, comment, feedback, everything I put here as a note. So there is nothing you have to take a note of. Just observe it, you'll get the clarity. The company decided to buy back 20,000 equity shares of 10 each. How many shares? 20,000 equity shares. Case 2, in the above case 1 was what? Case 1 we already discussed. The company did the buyback without adhering to the Section 68. So we saw when the Section 68 is not adhered to, the security of the external liability holders are getting reduced. Will this question come in the exam? No. This is for our understanding. Why compliance of 68 has to be done? If it is not done, what will be the problem? To conceptually understand, we did case 1. But questions will come based on case 2 and case 3. Now, case 2 says that in the above case, if the company has decided to issue 20,000 not equity shares, preference shares of 10 each in accordance to Section 68, then what would be the security of the external liability holders? Can we have a look at it? Now, Once again, Jana. In case 2, in the above case, if the company decides to issue 20,000 preference share of 10 each, which is as per section 68, then tell me what is the revised balance sheet, and as per the revised balance sheet, you have to tell me what is the security of the external liability holders. Am I loud and clear? Please tell me what is the journal entry for issue of preference share. Sir, bank account debit to preference share capital. Sir, but in 12th standard CA foundation, we studied that bank account debit to preference share application allotment, and then preference share application allotment to preference share capital. That drama is not required. That is required. But for explanation purpose, palm fellow, why should I do all the application allotment and confuse you? So I've done the direct combined entry. And you'll be surprised to see in certain places of your ICA model question, they have done the combined entry as well. So in exam, to save time wherever required, we'll do the combined entry. It is allowed by ICA. So please tell me, how many preference shares are issued? 20,000 into how much? 10. How much it is? 2 lakh, 2 lakh. And once the money is now collected, what is the next step? Buyback. Now, buyback, can I give you share entry as per the 1668? Can I give you accounting treatment as per law? Normally, it is what? Equity share capital to bank. Now, we don't want to do the entry directly. We want to complicate the entry. We don't want to eat like this. We want to eat like this. So now what will I do? I'll split this entry into 2 parts. So this will go as debit in one entry, and this will go as credit in another entry. So now, equity share capital account debit. How much? 2 lakh. 2. Equity share bought back. To buy back of equity shares. Equity share account debit to equity share capital account debit to equity share buyback. Any problem? Equity share buyback 2 lakh. So what is this? This is a temporary liability. The liability of 2 lakh rupees, which is there in the equity share capital account, for the purpose of buyback, we are moving this 2 lakh rupees from the capital account to a temporary liability account called as equity share buyback account. Why? Because when the buyback is announced until the date the buyback is completed, in between there are some days left. So that 2 lakh rupees should not be there in the capital account. So it is being moved from the capital account to a temporary liability account called as equity share buyback account. If you remember in bonus to shareholder, same thing we did. We passed 2 entries. Reserves to bonus to shareholder and then bonus to shareholder to equity share capital. Same way this also we do. So one is due entry, second is payment entry. This is what due entry and payment entry put together. But what are we doing? We are passing the due entry first and then separately the payment entry. So please tell me, what is my third entry going to be? This, all of that, very good. Equity share buyback account debit 2 lakh to bank 2 lakh. So ultimately what happens? If this account and this account is cancelled, what am I left with? Capital to bank only. Am I clear? Now please tell me, what is the impact of this 3 transaction on the balance sheet that we are discussing now? Please tell me what my revised balance sheet would look like. Equity from 10 it will become 8 lakh. Preference share capital 2 lakh will newly come into picture. Then free reserves will be as it is 2 lakh. External liability holders same 5 lakh as it is. And balance sheet bank will be same 17 lakh, because from 17 lakh first 2 lakh preference share capital came in, and from that only you made the payment. So same 17 lakh is kept intact. One second now. So now if I have to prepare the revised balance sheet after buyback, this is the balance sheet after buyback. These are the 2 entries. The second and third entry I passed it combiningly here for explanation purpose only, because I've mentioned the heading very clearly. Here the buyback journal entry only for explanation purposes. So capital from 10 lakh, 2 lakh gone, balance is how much? 8 lakh. And fresh 2 lakh preference share capital came into picture. This no change, 17 lakh, and bank balance also 17 lakh plus 2 lakh minus 2 lakh, same 17 lakh. So can we check the security of the external liability holders? So 17 lakh is the total money in the bank. In that you will keep 2 lakh separately for the distribution of dividend as free reserves. Balance 15 lakh rupees is the money available to the external liability holders, divide by 5 lakh shares, same 3 times the securities ensured, which was earlier, same 3 times. Before buyback, what is the security? Before buyback, 3, and after buyback, same 3 security has been ensured. So this is the beauty of section 68. Any problem in this? Online people, any problem in this?
So why did you not put
No,
No,
sir.
sir.
free reserves?
Why are we supposed to make change in free reserves?
Aren't you paying out of free reserves?
No, ma, you didn't listen to the question properly. What did I say here? In the above case, if the company decides to issue preference share, 20,000 preference share of 10 each in accordance to section 68. So the entire buyback proceedings is done out of the issue of preference share. Am I loud and clear? So now look at the conclusion. It's observed that on the compliance of section 68, the security of the external liability holders are unaffected due to the buyback. So we had earlier 3 as security, now 3 times. Now also it is same 3 times. That is the beauty of section 68. So this is one option. Hello. This is one option. Second option will be where you have your own funds itself, but I don't need to get any money from the external people. Then you can use the second option where you can transfer the amount that you're going to buy back from free reserve to CRR. So let's have a look into it. Total capital before redemption. Equity share capital how much? 200. Free reserves how much? 150. Total how much? 350. Now what is section 68 saying to keep intact? Only the capital part has to be kept intact. I'm talking only the capital should be kept intact. Am I clear? 200. The company bought back equity share capital worth 50. And since they have so much of surplus money, they are not issuing any preference share. So the company bought back equity share capital worth 50 and the company transferred the required amount to CRR. Now imagine this is not done. If this is not done, if you're directly buying back, then what happens? Your capital will reduce and your bank balance will reduce. When capital and bank balance both reduces, what happens? The security of the external liability holders reduces. So therefore, to ensure that the trust is being regained, section 68 says that whatever buyback you're doing, ensure on the same day the equivalent amount you have to transfer from free reserve to CRR. What does CRR stands for? Capital Redemption Reserve. Sir, if I transfer this into CRR, still this is not capital, no, sir. Then what is the ultimate purpose? You said that the capital of the company before buyback and after buyback should be equal. Capital before buyback, capital after buyback should be equal. CRR is not capital, no, sir. So even if I transfer the free reserve to CRR, CRR is not capital. How the capital is kept intact? For that, you have to refer section 69. What does section 69 says? Whatever money is parked in CRR can be used only for the purpose of bonus issue of shares. If you go and see section 69, section 69 says what? Whatever money has been transferred to CRR, the amount that is being parked into CRR can be utilized only for the purpose of issuing bonus shares. So whenever you're issuing the bonus share in the future, the capital of the company is going to 100% increase. So any external liability holders who has studied accountancy from Pratik sir, he knows that whatever amount is parked in CRR is going to be used as bonus issue. A bonus issue means what? Increase in future equity share capital of the company. So he will not be fearing. He will not be fearing. Understood the purpose? So now, when the company is bought back 50 rupees worth of share, what happened? From 200 rupees, 50 gone means it became 150. So one entry was what? Equity share capital account debit to bank 50 and 50. You have to pass another entry on your own where you transfer the amount from free reserve, that is free reserve account debit to CRR account 50 and 50. So 50 rupees gets reduced from 150, 50 gone means the free reserve balance is how much? 100. So where did that remaining 50 go to? CRR. So now 50 rupees is nothing but future capital which will be issued in form of bonus and plus current capital 150. Both put together how much? 200. So now if I add these both, total capital base is how much? 200 after redemption, and here also the total capital is 200 before redemption. Hence the capital has been kept intact. Any problem here? Now let's come back and see the same question, case 3. Same question. In case 1, what happened? The company did buy back, but they did not comply with 68. So because of that, who got affected? External liability holders security trust got affected. So case 1 not allowed. Case 2 we saw section 68 complied. How? By issuing preference share capital. Now case 3 says that in the above case, if the company had transferred an amount equal to the buyback, which is face value of the equity share capital, to the CRR in accordance with section 68, then what would be the security of the external liability holders? So please tell me, what is the journal entry for buyback? First due entry. Now, equity share capital account debit to equity share buyback. How much? 20,000 equity shares are bought back at 10 rupee each, 2 lakh and 2 lakh. What is the nature of equity share buyback account? Sir, it is a temporary liability. Now, upon payment, this temporary liability needs to be reversed. So, what is my payment entry? Very good. Equity share buyback account debit. To cancel the credit, I have to give a debit. So, this entry is like, purchase to creditor. And when you make the payment, what it is? Creditor to bank. So, like that, equity share buyback to bank. How much? 2 lakh, 2 lakh. Now, because of this, what happened? Your capital got reduced, your bank balance got reduced, and the security of the external liability holders got reduced. Now, to increase the security of the external liability holders, what are we supposed to do? We have to pass a third entry, suo motu. Means what? All by ourselves, we have to pass in compliance with section 68. So, what does 68 says? Transfer the amount from free reserves to capital redemption reserve. So, what is the reserve here? Free reserve. Can you give me example of free reserves? General reserve, dividend equalization reserve, very good. P&L, surplus, retained earning. All these are different names. All these are called as free reserves. So free reserves account debit. Free reserves will never come like this in exam. They'll mention which account of free reserve that is, whether it is general reserve or capital. What do you call it? Surplus or P&L. They'll mention the specific account name. That account you have to debit. To what? Capital redemption reserve, 2 lakh and 2 lakh. So now guys, before the buyback, what is the base of the capital? 10 lakh rupees before buyback. This is balance sheet before buyback, 10 lakh. Now after buyback, you have to ensure that the capital base is still same, 10 lakh. So can we see? Solution 3. 2 entries we passed. So now from 10 lakh, if 2 lakh is gone, what is your capital? Equity share capital 8 lakh. But to ensure that the capital base is retouched to 10, what did we do? We transferred the money from free reserve to CR. So how much was there in free reserve? 2 lakh was there in free reserve. The entire 2 lakh we had to transfer. So balance free reserve is 0. And this 2 lakh is come where? In the capital redemption reserve. What is the purpose of CRR? You can use that money only for the purpose of issue of bonus share. This point is mentioned where? In section 69. So now these both put together, even though CRR is not capital, but this is future capital. So these both put together, what is my capital now? Same 10 lakh rupees. If we come back again now, let's calculate the security of the external liability holders. So here if you see 15 lakh rupees, and how much is free reserves? 0. So 15 minus 0 is 15 lakh divided by 5 lakh. How many times? 3 times. So before buyback, we had the security 3 times. Even after buyback, by complying section 68, how much are we getting? Same 3 times. Logic understood or understood? Online people, logic understood or understood?
Yes, sir.
So we come back here. So we come back here, it says that section 68 teaches us how the capital before buyback and after buyback should be kept intact. So first option suggested by 68 is what? You can keep the capital intact by the process of issuing preference share capital, because for equity shares buyback, we cannot issue the equity shares of the same thing. So we have to only issue, the only option is preference share. Second option is if you have surplus money, too much of money, you are not relying on the external money. Here, we didn't have the own sufficient funds. So we had to go for further raising of capital. Here, you have a lot of funds. So what you can do, you can transfer the money from your own reserves account to CRR account. Now listen to me very carefully. Three reserves, rightly said by you. It is general reserve, surplus, P&L balance, then what? Dividend equalization reserve, then retained earning. Correct? These are normally called as surplus. But only for the purpose of section 68. Only for the purpose of section 68. Securities premium is also treated as free reserve, which means when I'm transferring the fund from free reserve to CRR, security premium could be used. Am I loud and clear? Online people, am I loud and clear? Where is this point mentioned, sir? So I had to pause the meeting to just open this. So this is nothing but section 68. Section 68, power of a company to purchase its own securities. Okay. In that, if you come down, I said no. Only for this section, free reserves includes security premium. So who's saying this? It is mentioned here, explanation 2. For the purpose of this section alone, free reserve includes security premium account, which means if I'm transferring amount equal to the face value of the equity share capital from the free reserve to CRR, security premium also can be utilized. Listen to very carefully. ICAI in the multiple questions of the study materials, even though the premium is available, they have not used premium in the sums. But in certain examinations, in the suggested answers, they have used premium in the calculations. Are you able to follow? So which means ICAI had earlier missed out on this point. Later, when they realized that in our questions, we are supposed to even adjust the security premium, when they did not do it, they started correcting in where? In the suggested answers of the examination. And they made a note below. At places where they did not adjust with the premium, though the premium was there, they started giving the note below. Rather, what they should have done, they should have first tried to adjust against the SPR, then they should have gone to free reserve. This would have been beneficial for the company. Tell me why? Because the amount that is parked in the security premium reserve account is got limited utilization. Section 52, subsection 2 of the Companies Act 2013 talks about the utilization of the security premium. So it has got very limited utilization. So please tell me, if I have 100 crores parked in the security premium account, can I use it for the expansion purpose? No. It is blocked. It is lying idle. Hence, as a prudent businessman, as a company, as an owner, what I'll do? I would want to free my locked reserves. This is a beautiful opportunity. Buyback is a beautiful opportunity where I can free my locked reserve in the premium account. So security premium should be done first and then followed by free reserves. Now, the question that comes is that, sir, whenever we solve the practical questions now, what are we going to do? We are going to do the same thing what the ICA has done. So wherever ICA has, transferred the money from free reserves to CRR, despite premium being there, we will do that only what ICA has been done. And wherever ICA is done, SPR first and then free reserves will do that. So now, okay, understood. Exam, what are we supposed to do? You do anything. Both are correct. Both are allowed. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Now, section 69. What is section 69? Where a company purchases its own share out of free reserves. Purchase its own share means what? Buyback. Where a company purchases its own share out of free reserves or security premium. How did they write security premium here? Because of section 68. A sum equal to nominal value. A sum equal to the nominal value of the share so purchased shall be transferred to capital redemption reserve account, and details of such transfer should be disclosed in the balance sheet. You have to give a disclosure in the balance sheet. That's why we give a disclosure, no? So this disclosure has to be given in the balance sheet. Look at the point number 2, subsection 2. The capital redemption reserve account may be applied by the company in paying up unissued shares of the company to be issued to member of the company as fully paid bonus shares. So for the purpose of fully paid bonus share, we can use this money. So which means if I'm using this money for the purpose of fully paid bonus share, then this CRR is my potential future capital. So the external liability holders need not worry about the money lying in the CRR account because that is equal to the capital. That is what is section 69 saying. So 69 says the utilization of CRR. The money which is lying in the CRR account, what can be done with that money is what is the description given in section 69. Any problem in this? Online people, any problem in this? Online people, am I loud and clear? Can I get a quick update from all of you?
Yes, sir.
Yes, sir.
Everybody, open your mouth. Like
Yes,
that.
sir.
Wonderful. Now, it's how much? 6:20 now. So I'll be giving you 10 minutes break. We'll come back and continue with point number 9. And along with that, example number 3. So let's take a quick break of 10 minutes. Thank you. Yes, people, welcome back to the break. So let's continue. So before we'll head forward to the next concept, let's do a quick recap of what we studied so far. Because there's so many small points, which is, if not recapped on time, you might forget it. So let's do a quick recap. Please tell me, what is the meaning of buyback? Repayment. Repayment before due date. Wonderful. Okay. Securities includes equity shares, preference shares. Securities is not capital. Equity shares, preference share, debentures. Okay. So when you're talking about repayment of which security are we talking about in this chapter? Only equity share. Can the buyback happen for the preference share? Yes, but it is not there in the syllabus. Can the buyback happen for the debenture? Yes. Is it there in the syllabus? No. So we're discussing about the repayment of the equity share capital. Buyback means what? Repayment before the due date. It is unplanned repayment. It's an unplanned activity. Okay. So when you do the buyback, you give the money to the shareholders and the shareholders surrender their share certificate, equity share certificate. And what do you do with that? You will tear it apart. Okay. So buyback of securities is nothing but repayment of capital. This we discussed. What are the different types of securities? We discussed. Securities got very elaborate meaning. Now I've included only 3 points here. Otherwise, we go and search as per Companies Act 2013, what is the meaning of securities? They've given a big paragraph. In that, I've cut short and discussed the points only to these 3 items. Okay. What is the difference between buyback and redemption? Redemption means repayment on the due date, on the agreed date, whereas buyback is before the due date. Okay. When I do the buyback, will it increase the capital or decrease the capital? It will decrease the capital. Okay. What is the first objective of the buyback? To increase the promoters holding or to increase the controlling shares of the company. Correct, no? So are you clear with the example that we discussed? How the promoters holding from 20 went to 25%? That example, are you clear? Okay. Second objective is to increase the earning per share. That example one same. 40 rupees per share was earning per share. It became later 50 rupees per share. Okay. Second is to avoid the hostile takeover. It means what? When the shares are in open market, public, gradually our competitors or external party will start buying those shares gradually without the company's knowledge in different names. And after a point, you see that that person holds majority of the share. So when the competitors or any other person holds a major share, they can fit in with the management of the company. They can create problem in the management of the company. They can create the problem in the decision-making process of the company. So to prevent the hostile takeover, buyback has to be allowed by the Companies Act to the shareholders. Second or third or fourth object is what? If you have any surplus money left over, you can use that surplus money to repay the capital back. Next, to leave positive impact in the stock market. This we discussed in depth, so I'm not touching one more time. Next, to improve the capital-based accounting ratios. All the accounting ratios affecting your capital, total shareholders' funds, that is getting better. For that purpose, this buyback is being initiated. Okay. Now, when you do the buyback of the shares, you have to adhere to which 3 sections of the Companies Act 2013? 68, 69 Jain and 70. 68, 69 and 70. If you do not follow what is mentioned in 68, 69 and 70, Who will get affected here? External liability holders gets affected. Their security will reduce. So we saw example 2 and 3, how the security of the external liability holders are getting reduced because of buyback when 68 is not being followed. Okay. Section 68 says that you have to keep the capital before the buyback equal to the capital after buyback so that the trust and the security of the external liability holders are retained. For that reason, Section 68 suggested how many alternatives? Two options, two alternatives, two methods. One is by way of issuing preference share. Second is transferring the free reserves to CRR. Only for the purpose of Section 68, free reserves includes security premium. Security premium. Am I clear? Now, if you come back to this, in method 2, transfer of free reserves to non-free reserves, which is CRR, what I tell you, for the purpose of buyback, Section 68 under explanation 2 allows security premium to be used as free reserve to transfer the amount to CRR to keep the share capital intact. However, ICA does not do so in all the practical questions, but in selected questions only. So when you see there is an security premium in the question, and don't be surprised if the ICA question does not use SPR. In some question they are using it, some question they are not using it. So accordingly, we can make an assumption in doing the examination. There is one thing called as revenue reserve that will be given in some question. So revenue reserve is nothing but another name for general reserve. Now free reserves are given. You have to transfer the money from free reserve to CRR, but there are multiple type of free reserve. The free reserve are in name of general reserve, P&L balance, surplus, retained earning, dividend equalization reserve. So which one I should use first? Is there any order given? Section 68 has not given any order. You can use it anyhow you want it. Am I loud and clear? Online people, am I loud and clear? Now there's a question that was asked. Sir, in section 68, you're telling that for the purpose of this section, free reserves include security premium. Whereas if I talk about section 52, what is section 52? Section 52 talks about how the premium received, the premium which the company's got, no? How the premium needs to be applied or how the premium needs to be utilized. So what is the first purpose of using the security premium? Point number A, if you see, I can't do anything here. This is point number A, if you can see. The security premium that you have collected, how does the security premium come into picture? When you issued the shares at premium, bank account debit to equity share capital to security premium. So that money what you've got, that money has got limited application and utilization. So the first purpose is what? Towards the issue of fully paid bonus share. Any fully paid bonus share. For the purpose of fully paid bonus shares, you can use this amount. Second, you can use this account money for writing off the preliminary expenses. For the purpose of writing off preliminary expenses, you can use it. Third, you can use security premium amount for the purpose of writing off the expenses. Which expenses? The commission paid or the discount allowed on the issue of shares and debentures. If any shares and debentures are issued, and for that if you are supposed to pay any commission to underwriters, or if there is any discount or loss on issue of debenture, for that this amount can be adjusted. Next, for providing, that is writing off premium payable on the redemption of preference share. That is, when I'm going to redeem the preference share, I'm going to redeem at premium. I've issued at face value, but I'm going to redeem at premium. All this where did you discuss? I'm not teaching this freshly now. This is something which you have already discussed in foundation. I'm just doing the revision now. So, premium that you pay on the redemption of preference share. You issued the preference share today at 100 rupees, but in future you're going to redeem at 110. So extra 10 rupee what you're paying is from your pocket. That is a loss. So that loss can be written off from the premium account. So providing the premium payable on the redemption of redeemable preference share and debentures. If the debentures and the preference shares are going to be redeemed at premium, extra amount, that extra amount is a loss. And for writing off loss, you can use security premium. Point number E says what? For the purchase of its own share. For the purchase of its own share, which is nothing but for buyback under section 68, you can use security premium. You can use security premium. So the question what Jain asked is, here in point number E, they have told no that we can use premium for the purchase for the purpose of buying back. Then why it is in section 68, they have given this information one more time. Why? Because here they have told in explanation 2 that free reserves can be only transferred for the purpose of only free reserve will be transferred to keep the capital intact. To keep the capital intact Specifically, they're telling to keep the capital intact, free reserves has to be transferred from free reserve account debit to CRR account. So in that, premium can be used or not used is not clear. Though they've told it is for buyback here. If you see this point, though section 68 says that it can be used for the purpose of buyback, not 68, sorry, 52. 52 subsection 2E says that you can use this for the purpose of buyback, but how this premium has to be utilized for the purpose of buying back? Because you can buy back the shares at premium. So that premium which is coming for the purpose of buyback, for writing off that premium, should I use the security premium or not? The question was not clear about it. Now understand, one more time I'm telling you. Now what we discussed so far is what? Buyback is at par. Means what? 10 rupee equity share capital I took. I'm repaying 10 rupee back. We'll be discussing the upcoming questions where you can repay the money back. Buyback has to be done at the higher rate, at the premium. At the premium. So premium is there, which is a loss. So that loss can also be utilized for the purpose of writing off against the premium. So this point E is talking about what? The question is not clear. Hence, in 68, they have to specifically mention that when we are transferring the amount from free reserve to CRR to keep your capital intact, here for this purpose, security premium can also be utilized. Like that, they are giving more clarity in this provision, in this section. Am I loud and clear? Online people, am I loud and clear? Please tell me. Everybody sleeping online.
Sir.
Huh? So the question what Jayesh was asking is that, sir, in section 52, subsection 2, clause E, already they mentioned that the premium can be used for the purpose of buyback. So why in section 68, one more time this point was mentioned? That was his question. Am I right? So I gave the explanation for that, telling that the premium here is not only in this scenario. When the buyback is done, the buyback also could be done at premium. So when the section 52, subsection 2, clause E says that the premium can be utilized, it is not clear that I can use the premium amount also for transferring to CRR. So to give clarity there, in section 68, explicitly under explanation 2, this has been included. So that there is no confusion, ambiguity. Am I loud and clear? Now, coming back to point number 9. A company can buy back only fully paid equity shares. Which means if the partly paid equity shares are there, you cannot buy back. But my question is, if you buy back partly paid equity shares, what will be the consequences? My question. For that, let's refer question number 3. Everybody will tell and stop here that buyback should be done only for fully paid equity shares. If it is partly paid, then what are we supposed to do? Make it fully paid and then do buyback. My question is, if you do partly paid shares ka buyback, what will happen? The consequence you have to know. No? Somebody is telling that partly paid buyback, you don't know. He knows the reason. Do you know? So you should know the reason or not. That is my understanding. So now example 3. Balance sheet of XYZ Limited before buyback. 1 lakh equity shares, 8 paid up out of 10 rupee face value. 10 rupees the face value. In that 8 is paid up. So what is your equity share capital? What is your equity share capital? 8 lakh. Free reserve how much? 2 lakh. External liability? 5 lakh. So total liability how much? 15 lakh. And in back how much do you have? 15 lakh. Now, please calculate and tell me. Please calculate and tell me what is the security of the external liability holders. Please calculate the security of the external liability holders. $2.6. How did you calculate? 6. How much it is? 2.66560. Okay, 2.6 times. Wonderful. With my reaction, you have understood that what calculation you guys have done is wrong. Tell me why it is wrong. 5 lakh external liability holders is not dependent on 15 minus 2 alone. He is also dependent on the remaining 2 rupees per share what you will bring in future. Yes or no? When the external liability holders is lending credit to you, creditor is lending goods to you on credit. When the banker is lending loan to you, he is not just attracted by this 15 lakh. 15 lakh minus 2 lakh, 13 lakh is attracted, no doubt. This 13 lakh is safety margin, no doubt. But on 1 lakh share, how much is not yet called? 2 rupee not yet called. If that 2 rupee, if I call, how much it is? 1 lakh into 2 plus 2 lakh. then actual 15 lakh rupees is what? Is the security of the external liability holders. Because that 2 lakh also will come to me in future, no? So the actual is how much? 15 lakh plus 2 lakh is what? Called up capital, which I'll call in future. Minus 2 lakh is what? Free reserves. So 15 lakh rupees is your security margin. Upon 5 lakhs, how much is safety margin? 3 times is the safety margin. This is the safety margin before buyback. Any problem here? So you understood why I did this concept with you. I know this mistake will happen, but the concept does not end here. This is the beginning of the concept. Now comes the main point. In the above case, the company has decided to buy back. In the above case means what? When the shares are partly paid, that time itself the buyback is happening. This is not allowed. But I want to make you understand that if the buyback is done for a partly paid share, what is the impact? On whom it is getting impacted? We have to assess it. Now I'm telling you the above case means partly paid scenario. The company has decided to buy back 20,000 equity share of 10 each by transferring free reserve to CRR. So which method have they opted? 1 or 2? Method 2, where they're trying to transfer the amount from free reserve to CRR and comply with section 68, which means they're trying to comply with section 68, where they want to keep the capital intact. But what section 68 violation is happening here? Partly paid is not completed to fully paid. Without partly paid being fully paid, they are doing the buyback. That is the violation of 68. But other part, keeping the capital intact, that part they have taken care of. Show how the security of the external liability holders would be affected if the partly paid equity shares are bought back. So now what is entry, people? What is entry? 20,000 shares you're buying back. So how much money will you repay back? Sir, 10, out of 10 rupee, 8 rupee I got. So 8 rupees is what I'm going to pay back. So 20,000 shares into 8 rupee means how much money I'll pay back to them? 160. I'm doing buyback at par. So equity share capital account debit to bank 160, 160. Since the capital is reducing, to keep the capital intact, I'm transferring 160 from free reserve to CRR. Correct? Now, how does the balance sheet look like? Capital was 8 lakh. In that 1,60,000 got. So balance is how much? 640. And in place of that, CRR came for 160. If 160 is reducing here, 160 got added here. From where? Free reserve. So free reserve was earlier 2 lakh. From that 160 gone means how much is the balance free reserve? 40. External liability holders, same value. Bank how much? So earlier we had 15 lakh rupees. In that you paid 1,60,000 rupees. So balance is how much? 1340. Now please tell me, what is the security of the external liability holders? 13,40,000 money available. 13,40,000 money available. Now on the 80,000 share, the 2 rupees expected in future, no? So on 80,000 share, the 2 rupee will be called up. So how much future money you're expecting towards capital? 1,60,000 rupees plus 160. And how much is free reserve? 40. So minus 40. So how much is the external liability holder security margin? 14,60,000 out of 5 lakh. So what is your margin now? 2.92. What was the security margin before buyback? 3. And now after buyback, 2.92. Despite you complying with section 68, where you kept the capital intact, despite the security margin is reducing. Why? Because the remaining 2 rupees is there not 20,000 share that you did not collect. 20,000 into 2 rupees, which is how much? 40,000 rupees, which as the external liability holders, I was relying on this 40,000. This 40,000 never collected. Hence, my security got reduced to the extent of 40,000 rupees. So if you buy back the partly paid up share, your security is getting reduced by 40,000 rupees. So the external liability holders are still getting affected. Even though you kept the capital intact, you tried to keep the capital intact, correct? No? 160 reduced and you added 160 in CRR. So you kept the capital intact despite that the security got reduced. Hence, this is the reason why the partly paid up shares cannot be bought back. So if you want to buy back the partly paid up shares, what it is supposed to do? Make it fully paid. Make it fully paid. With the above example, we understand that if partly paid shares are bought back, despite complying with section 68, keeping the capital intact, still the security of the external liability holders are getting reduced from 3 to 2.92. Still, the security of the external liability holders are getting reduced as the capital base was not increased for those 20,000 shares at 2 rupees, which is 40,000. To the extent of 40,000 rupees, the external liability holders was dependent on that 40,000 rupees. You did not get that money. To that extent, I got affected. As an external liability holder, I got affected. And the external liability holder are deprived of such capital of 40,000 rupees. For this reason, partly paid shares are not directly bought back. They are made fully paid up either by making the call or using the free reserve to increase the capital base, and then the buyback process is initiated. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Now the question is, how is the buyback of the partly paid equity shares done? This is the same way it is done, how we discussed in the redemption of preference share. Bonus share, we discussed this point. When the bonus shares are partly paid, you cannot issue bonus shares. When equity shares are partly paid, you cannot issue the bonus share. So this is the same chart that we discussed in CA Foundation that I'm going to discuss one more time here. Now, what is the option? For the 20,000 rupees, what is the option? I have to make call. I have to make the call and receive the money. So now please tell me, if I make the call and receive the money, what will be the journal entry? So when the shares are partly paid, to make it fully paid, you have two methods, method 1 and method 2. Method 1 says what? Method 1 is make that call. Method 1 is make the call, receive the call money. If the opposite person is not willing to pay the money, you have method 2. What is method 2? I'll discuss after method 1. So method 1 means what? Upon receiving the final call money in the bank from the shareholder, convert the partly paid shares into fully paid shares. So what is the journal entry for making the call? Equity share final call account debit. How much? 20,000 into 2, which is how much? 40,000 to equity share capital 40,000. This is the due entry. What is the next entry? Very good. Bank account debit to equity share final call 40,000, 40,000. So please tell me what and how the balance sheet look like after this entry. No, you're telling me including that. In this question, 8 lakh is the capital. Actually, you have to make the entire call on. Sorry, it's not 20,000 alone, because you can't say no. Those people who are buying back, for them only I'll give 2 rupees. No, so you have to buy back the entire. Sorry, you have to make the call to the entire group of people. So it'll be full 1 lakh into 2. 1 lakh into 2. See, when you make the call, you will not say no. Hey, 80,000 people, I'm not buying back your share. So you don't give me the call money. And remain 20,000 people, I'm buying your shares. Give me. Buyback means what? I'm giving the offer. Anybody can come and give the shares, surrender the shares certificate, get the money back. So who will come? I don't know. No? So I have to make the entire group fully paid. I have to make the entire group fully paid. So now it will be 1 lakh into 2. How much? 2 lakh and 2 lakh. Okay. Please change. So by that virtue, what happens here? Your equity share capital. Yes. So this and this has been closed. So what I'm left with? Increase in capital, increase in the bank balance. So how much is existing capital? 8 lakh plus 2, how much? 10 lakh. So equity share capital 10 lakh. How much is the bank now currently at present? 15. It becomes now 17 lakh. What is the free reserve? 2 lakh. External liability holders 5 lakh. So when you try to calculate, 17 minus 2 is 15. 15 by 5 is how much? 3. Correct? Now you have to do the buyback. So when you do the buyback, what happens? You know the result. So already the cases based on that we have seen. Whether you use preference share as a tool to buy back, or when you use the free reserve to transfer to CRR as a tool to buy back, anyways, it's still going to be same three types. Am I loud and clear? So this is one option where you can make the call and convert that partly paid into fully paid. You make the call and you receive the money. So you receive the call money. This is how you convert your partly paid shares into fully paid. Now, second option is what? The remaining 2 rupees you do not call to the shareholders. That 2 rupees is a bonus from your side. This is what is the concept we have discussed elaborately in the CA Foundation called as bonus issue. Bonus issue. So bonus means what? I'm giving additional free shares. I'm giving additional shares to my existing shareholder free of cost. This is one option. Second option is out of 10 rupee, I tell the gentleman, you just pay 8 rupee from your pocket. Remaining 2 rupee, I will pay from my reserves. So what is bonus? Bonus is nothing but capitalization of reserves. Capitalization of reserves means what? You're transferring the money from your reserve account debit to bonus account, from your reserves to bonus account. So which reserve account, free or non-free? Very clear in bonus, we agreed that we have to transfer only free reserves. So free reserves. Reserves is what balance? Credit balance. To reduce reserves, what am I supposed to do? Debit. So free reserves account debit to bonus to shareholder. How much? 20,000 into 2. Is it right? Can we give bonus only to these 20,000 people? No, it'll be for entire group. Because when I'm giving bonus, I cannot give bonus to part people. I have to give the entire people only the bonus option to be done. So it'll be 1 lakh into 2, which is 2 lakh and 2 lakh. So 2 lakh rupees you're transferring from free reserve to bonus to shareholder. Bonus to shareholder is a temporary liability account. This is which concept? CA Foundation concept. Didn't I tell in the beginning? For intermediate, what is important? Foundation as a base is important because foundation is accounting. Interest, advanced accounting. Can I teach the entire bonus issue now? I can teach, no problem. As a teacher, I can teach. But will I be able to complete the syllabus on time for intermediate people? No. That's why whoever came as that entry and whoever is not strong with the basics of foundation, I gave them the extra classes which you have to see there as recorded so that here you can correlate. Bonus to shareholders is what account? Temporary liability. So that temporary liability is being closed and we are giving the credit to equity share capital account. So if I merge both the entries, what will happen? Bonus to shareholder gone. So what am I left with? Free reserve to equity share capital, which means what? The amount in free reserve is transferred to capital. Now please tell me, what does my balance sheet look like? Sir, equity share capital earlier was how much? 8 lakh. Now by transferring 2 lakh from free reserves to equity share capital, I have converted partly paid to fully paid. It became now 10 lakh. So 8 lakh the opposite person paid and remaining 2 lakh I paid as a reserve. From my reserve I paid it. It is on behalf of the shareholder. This is how I converted the partly paid to fully paid. This is allowed by law. Now your free reserve has become how much? 0. Free reserve has become 0. What is external liability now? 5 lakh. And what is the bank balance? 15 lakhs only. Because I did not get any money further. So whatever the balance sheet was there prior to this, same balance sheet, same 15 lakh. It is only that because of this entry, your free reserve got transferred to your equity share capital. Rest all same. Now you can proceed with the buyback. Now please tell me what is security margin? 15 minus 0 by 5, which is 3. Now please tell me, can I do the buyback out of the free reserves? When I do the buyback, I have 2 options to keep the capital intact. One is issue preference share capital. Second, transfer from free reserve or security premium to CRR. Second option can I use? No, because I have no free reserve, I have no security premium. So this company, if it wants to buy back, it can only do by way of issuing preference share capital. So through preference share capital, you get the funds required to buy back the shares. How many shares? 20,000 into 10, which is 2 lakh shares to buy back. I've issued 2 lakh worth of preference share capital. Is the logic clear or not clear? Yes, sir. So what did we discuss now? We discussed saying that partly paid equity shares cannot be bought back. If it is partly paid, you have to make it fully paid. Now I have taught you why partly paid shares cannot be bought back. If you buy back the partly paid share, what is the consequences? Who will bear the consequences? That logic I gave you. That understanding I gave you. And second, I taught you that if you want to convert your partly paid to fully paid, you have 2 options. One is you can make them the call and receive the call money. Or second, you can transfer the money from your free reserve account debit to equity share capital account. Ultimately, yeah, through bonus to shareholder only. But ultimately it's going where? To your equity share capital. Now tell me, do you have any problem in this so far? Online people, do you have any problem in this so far?
No, sir.
No, sir.
Fantastic. So can we do one question? Example 4. Example 4. Just observe the question. Buyback of fully paid shares at par by using own funds and by issuing new shares. This is the heading that I given. See, sometimes the buyback is at par, sometimes it's at premium, sometimes it is a discount also. Yes, yes, I'm coming. So I've made the heading, I've given the heading very clearly. So when you read the examples, you'll understand that this example is for what? Balance sheet of XYZ Limited. Balance sheet of XYZ Limited is given. Equity share capital of 1 lakh quantity of 10 each. How much? 10 lakh is capital. Already a 9% preference share capital is existing. How much? 6 lakh. General reserve 8 lakh. What reserve it is? Free reserve. Security premium. Generally non-free. Only for the purpose of section. Only for the purpose of section 68. It is free. So it is typically non-free reserve. It's a non-free reserve. But for section 68, it's a free reserve. Okay. Capital reserve. Non-free reserve. Non-free reserve. External liability, external liability. Bank balance 14 lakh, other asset 46 lakh. Any problem in this? No problem, sir. Okay. Case 1. The company decides to buy back 20,000 equity shares at 10 each. How many shares are there totally? 1 lakh. Out of that, how much are they buybacking? 20,000. So what is the percentage of buyback? 20%. 20 upon 1 lakh into 100. So 20% shares are bought back at 10 each by utilizing its own resource. Show how the buyback would be impacted in the equity share capital. Okay. Now please tell me, what is a journal entry? First, I have to pass the due entry. Due entry for transferring the amount from capital account debit to buyback account. So what is the due entry? Equity share capital account debit to equity share buyback. Very good. Equity share buyback account. How much shares have been bought back? So 20,000 shares we are buying back at 10 rupees. So buyback price is 10 rupees, same 10 rupees face value. So how much it is? 2 lakh, 2 lakh. When I do this, my capital base is reducing. So to increase my capital base, what am I doing? I'm transferring the money from my own resources to CRR. Who is saying this? Section 68. So please tell me, what should I do now? I have two options here. General reserve and security premium. But ICI, what does it do first? General reserve. Technically speaking, if any prudent businessman is there, I would definitely want to utilize 5 lakh first because this is blocked. So by transferring it to CRR, I can use it for bonus issue purposes. So this becomes more free to me. I will do that. But ICI has done what? Everywhere, mostly they've done GR first, free reserve first. But what will you do in exam and come? Security premium and give a note and reference to the section. How the note should be given, I'll tell you when we do the question from scanner. That note is given by your ICA institute only. CA institute is only given the note. Same note we are going to copy paste and come. If you are going to use SPR for the purpose of transferring to CRR. But if you're trying to use only GR for that purpose, then that note can be avoided. Who has given that note? ICI itself is given the note. Okay. So now for our convenience purpose, I'm using only GR. So what is my entry going to be? GR account debit to CRR. How much? Amount equal to face value. Amount equal to face value only have to transfer. Sir, only 2 lakh is there. No, sir. That only I'll transfer. No. In next question, I'll tell you that 2 lakh worth of share is being given at a premium of 50,000. So 2 lakh 50,000 rupees I have to repay. That time when you transfer the money to CRR, will you transfer only 2 lakh or full 250? 2 lakh. Only 2 lakh because I have to keep only capital intact. So how much is the capital getting reduced? 2 lakh. So only that much I have to transfer, even in case of premium or whether it is in case of discount also, I'll transfer the amount equal to face value only to the CRR. Am I loud and clear? Okay. Now 2 lakh and 2 lakh. Now do you have the bandwidth or option to go ahead and make the payment? The answer is yes. Now you can make the payment. Without this entry, you could not make the payment. Now since you have reinstated the capital level, you can go ahead and make the payment. So please tell me the payment entry. Equity share buyback account debit to bank. Very good. 2 lakh and 2 lakh. Any problem? That's all. These are the only 3 entries. Sir, in this entire chapter, are these the only 3 entries? See, from the buyback point of view, we have some 3-4 entries like this. Apart from that, in this question, what will happen? Preference share is issued. Investment is sold. Money is not sufficient. Investment sold. bonus to shareholder entry will come. So like that, multiple entries are coming and making this all the more complicated. Sometimes it is sold at premium, then premium we have to write off. So basic buyback entries are this only what we discussed today. But all the masalas will come in between extra. So all the ICA question is full of masala. So where do masala now? First day itself you have masala. Let's say you've done fasting for 10 days. The first meal what you're having is masala meal. What will be reaction of your tummy? So that I'll get to know only next day morning, sir. Correct, no? Same way, if you take the ICA question, first question is full of masala. If I do that masala question in the first day, gone. Next day will not come back to my buyback class. So today I've ensured that I'm giving you all the basic questions to feed the concept in head. அதாவது injection குத்தும் இல்லையா? What we do, we'll take that spirit nicely, we'll rub, no? The chill feeling we give. Then we'll first spirit chill, it'll be chill, no? Smell also will be nice. How many of you like that spirit ka smell? Don't like? You like it, huh? That is to attract us. அது வச்சுட்டு அப்படி என்ன பண்ணுவாங்க, குசு குசு குத்திடுவாங்க. அந்த மாதிரி first 2 classes I'm trying to spiritify you. Correct, no? Third class onwards, chick, 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 chick. So be ready for that. Now, case 1, GR2 capital redemption reserve. என்னாச்சுப்பா? நம்பல அவன் வாங்க சார் நான் பாத்துக்கிறேன்றாங்க. சரி, okay, right. GR2 CRR, I've kept the capital base increased. The equity share capital to equity share buyback, then buyback to bank. Will you present this balance sheet and come in your examination? This is only for understanding purpose, because we are more comfortable with this. Childhood memories, 11th standard, 12th standard childhood memories is the T-shaped balance sheet. Correct, no? So I'm just taking the advantage of your childhood memory. Now, how does my buyback? How does my buyback mean? Balance sheet looks after buyback. So equity capital earlier was 10 lakh. After 2 lakh gone, how much it is? 8 lakh. Preference same 6 lakh as it was earlier 6 lakh. We didn't touch, same 6 lakh. So what is the capital base before? What is the base capital before? Equity plus preference 16. Now after buyback should be same 16. So now equity is how much? 8. Preference how much? 6. 8 plus 6 is 14. So to keep the capital base intact, what did we do? We transferred 2 lakh from GR to CRR. 2 lakh. So this 3 now becomes the same family, capital family. CRR, the amount should be transferred to CRR, and the utilization of CRR is mentioned where?
69.
Section 69 only talks about the utilization of CRR. What is the application of CRR? Only for the purpose of bonus shares. Wonderful. So the capital before and after redemption is same, 16 lakh rupees. Any problem? No problem. Case 2. Instead of case 1, case 2. Instead of using own funds, now the company decided to buy back 24,000 equity shares at rupees 10. Buyback price is 10 by issuing new 9% preference share of 10 each. The preference share of the same class is being issued now. The preference share of the same class is issued now. Now to buy back equity, can I issue equity share here? Instead of preference share, can I issue equity share? Can I issue equity share here? No. The Companies Act does not permit to issue equity share. The logic of that has already been discussed. So please tell me, what is the journal entry? First, due entry. Due entry what? Equity share capital account debit to equity share buyback. How much? 24,000 into 10, which is 2,40,000. Now your capital base is shaken. To reinstate my capital, what am I doing now? I'm issuing? Yes. Sometime I say will do bank to preferential capital. Sometime I say will do bank to preferential application allotment and preferential application allotment to preferential capital. Both drama they'll play. Now in exam, what are you supposed to do? You have to see what is the requirement of the question. If they ask you journal, full balance sheet with notes, only for 10 mark, then do combined entry income. But if the same question asks for 15 mark, then what will you do? You will do masala entry income. Bank account debit to preferential application allotment, and then allotment to 9% preferential. Like that, you will split and show. Mark 15 mark. So accordingly, you have to expand and write income. No, 10 mark means who will sit and waste my time? 10 mark means do you want to combine entry? 10 mark avla mare da. Okay, mama. Okay. Now combined entry please. Bank account debit to 9% preference share capital. Wonderful. How many shares did you issue? Same 24,000 shares at 10 rupee. How much it is? 2,40,000. 2,40,000. Okay, sir. Now, are you good to make the payment? Yes. So, what is the payment entry?
Yes, sir.
Equity share buyback account debit to bank. How much? 240, 240. Now, if I change the order of this question, are you okay with it? For example, if I pass this entry first, if I pass this entry first, means what? Capital, that is keeping the capital intact entry first, and then due, then payment entry. Are you okay?
Yes, sir.
No. So this will be first here onwards. This will be second, and this will be third. First, I will try to arrange the money. I'll try to increase the capital as per 68. I'll do all the compliances first. Then I'll pass the due entry for payment, and then finally I'll do the payment. Any problem in this part? Online people, any problem in this part?
No, sir.
No problem.
No, sir.
Now please tell me, what is the impact of this on the balance sheet? So currently balance sheet is how much? Like this. So equity has become now how much?
7,60,000.
Equity share capital
7,60,000.
from 10 lakh, it has become now 7,60,000 because 240 has been redeemed. So 10 minus 240 is how much? 7,60,000.
760.
So 10 minus 2.4. Preference share capital, how much was there earlier? 6 lakh was there earlier. Now you have issued 2.4 more. How much it is? 8,40,000. Okay. Then your GR is how much? Same, sir. 8 lakh. We did not touch here. We did not utilize GR here. Security premium? Same 5 lakhs. Security premium reserve? Same 5 lakh. Capital reserve? Same 7 lakhs. External liability? Same 24 lakhs. Bank? No. Bank is same, but we have to make the adjustment. How much? 14 lakh was earlier. Plus 2.4 lakh minus 2.4 lakh. How much? 14 lakh. Other asset how much? 46 lakhs. Now, what does section 68 says? The capital base before and after should be same. How much was it before? 16 lakh. How much is it now?
16 lakh.
Add these both, it becomes 16 lakhs. Any difficulty?
No, sir.
Online people, any difficulty in this?
No, sir.
First, receive the money towards preference share capital, due entry, payment entry, and this is the balance sheet after the buyback. So now the share capital before buyback was 16 lakh, and after buyback, that is equity and preference put together same 16 lakh as before. In previous case, I gave the same conclusion. Share capital before buyback was 16, and after buyback, that is equity, preference, and CRR put together is same 16 lakh as before. Okay. Till this, any doubts?
No, sir.
Okay. Now Nishi's got some doubt in the concept of converting partly paid to fully paid. Yes, a doubt, please.
In the third case, does security premium count as free reserve?
No. See, the question what Nishi is asking here is that, sir, here you have given free reserve. No. Here, can I consider security premium as free reserve? No. Security premium can be considered as free reserve only for the purpose of section 68. And 68 is talking about what? Buyback, keeping the capital intact. Section 68 does not talk about converting the partly paid to fully paid. This free reserve to bonus to shareholder is for the purpose of converting the partly paid to fully paid. This part is not a part of a section 68. Section 68 is saying that to do buyback, you do the partly paid to fully paid. How to do fully paid? Some other section is saying. In that section, free reserve means only free reserve, not security premium reserve. So security premium reserve can be used for the purpose of free reserve when I'm transferring the amount from SPR to CRR to keep the capital intact. So typically, this part, to keep the capital intact, I've given method 2, no? In this method 2, free reserve includes security premium. Am I loud and clear? Yes.
Collecting cash. In bonus, In bonus issue, we thought it was collected in cash.
वहां पे ऐसे कुछ भी नहीं बोला. It's obviously collected in cash only. Now, any doubts so far?
Sir, in that one we use like a combination of preference shares.
Now, next question is based on that only. Everything is there. You think about it, there's a question here. Now, example 5.
Sir, security premium will be used for bonus shares.
Bonus shares.
Bonus share is
Section 52.
subsection.
Correct? Okay, now question was Kritin is asking, he forgot bonus to shareholder. Now, Kritin is saying, sir, for the purpose of bonus share, we can use security premium, no? That is when the fully paid bonus shares are, transferred from reserve to bonus to shareholder for giving the, bonus issue, fully paid of bonus issue, that time only security premium can be used. First, CRR will be used. Then capital reserve, then security premium, then free reserve. To what? Bonus to shareholder. This is what? This is the journal entry for issuing the bonus share. Which bonus share? Fully paid bonus share. So what Kritin is asking that. So here SPR used, no sir. Now the SPR I'm not allowing you to use here because in bonus share what I said, when you're converting partly paid to fully paid. When you're converting partly paid to fully paid, SPR cannot be used it, and in the bonus to shareholder notes, I put SPR in red and taken off. That SPR cannot be used for purpose of converting partly paid to fully paid. That's why I told you if anybody's got confusion, please get the videos from Anita ma'am. You can sit and watch the bonus to shareholder one more time properly, because there each and every point, like how I'm discussing it now here, there each and every point of bonus to shareholder extensively was discussed. So if you have a confusion, if you're clear, then you can leave it. Entry wise, chiller entry. For that, you don't need to see my class. I'll tell you entry, you just keep in mind, game over. But if you want to know the concept of bonus to shareholder, which you felt that I did not understand in the foundation earlier, and now I want to understand properly, you can watch my video one more time, if need be. So this is the tricky part. I'm telling you, as we go by, so many entries are going to combiningly come. So SPR where to use, where not to use. Free reserve where to use, where not to use. So that is the confusion point in the entire chapter. That is why the frequent revision is very, very important. So 10 times I'll repeat each point. For this, what will we use? What will not use? Like that, when I revise n number of times, automatically will be clear as to what needs to be done. This is that easy a chapter. But when we have so many entries together with multiple condition, it becomes a little bit confusing for us. To avoid confusion, what is essential? Clarity of the concept and me repeating multiple times, revising it. You revising at home will only help you to ensure that the confusion is not there. Am I loud and clear? Now let's do one more question. With that, we'll wind up. Example 5. Buyback of fully paid shares at a premium. It's now at a premium. If you look at the question, equity share capital is 20 lakh. Description is how? 2 lakh capital at 10 each. Means 10 face value, 10 fully paid. So this is fully paid equity share capital. Can I issue the can I do the buyback here? Yes. 9% preference share capital, how much? 5 lakh. General reserve, 4 lakh. Premium, 1 lakh. External liabilities, 21 lakhs. Particulars, bank 18 lakh, other assets 33 lakh. This balance sheet format I gave only for understanding and convenience purpose. In real, you will never get the balance sheet like this in the exam. I'm giving that disclaimer already. This is only for discussion purpose because we feel very comfortable discussing this way. Company decides to buy back 40,000 equity shares of 14 each. Of 14 each, at 14 each. How much is the face value of the share? 10. What is the buyback price? 14. So difference 4 rupees is what? Premium on buyback. Premium on buyback. So company decided to buy back how many shares? 40,000 shares out of how many shares? 2 lakh shares. If 40,000 shares are bought back, what is the remaining number of shares? 1,60,000 shares. And this I'm doing by way of issuing 25,000 quantities of 12% preference share. Means another class of preference share. Is it allowed? Yes. For equity, I can use preference. Any class of preference, 9%, 10%, 12%, that is no restriction. I can issue 12% preference share, which is a separate class other than 9% allowed.
In case of differences, we can issue debentures.
No, that is what I'm coming. I'll just give me some time. 12% preference share of 10 each and remaining by utilizing the own fund. So this is a question where we have both method 1, method 2 coming together. To keep the capital intact, little bit of preference share capital, little bit you will transfer from your reserves to the CRR. Am I loud and clear? Okay, wonderful. So what did we agree first? First, we'll do the entry for keeping the capital intact. But for that, you have to become pro now. You're not yet pro now. So here I'll do first due entry. So what is the due entry now? Very good. Equity share capital account debit to equity share buyback. You will not do this entry now. Like now we're doing because you're not a pro. So you don't know how much of the face value is reduced. You're able to understand. Once you become a pro, once you have that visualization, this entry will not do first. First will be the entry for keeping the capital intact. Okay. Okay. What is entry you said? Equity share capital account debit to you are buying back 40,000 equity shares at 14 per share. So how much rupees you have to pay back? 14 per share. So two equity share buyback should be 40,000 into 14. How much it is? 560. Here it should be 40,000 into which is 4 lakh. So difference of 60, how much? 1,60,000. Difference of 1,60,000 is nothing but premium on buyback of shares. How much? 40,000 into 10. Sorry, 4. Now, equity share capital you have debited because equity share capital is credit balance. To increase capital, credit. To decrease capital, debit. So, I'm decreasing capital, hence I gave a debit. I'm decreasing the capital, and hence I gave a debit. When I'm buying back the shares, before I buy back the share, I got how much money from the shareholders? 10 rupee per share. But when I'm repaying now, how much I'm paying? 14 rupee per share. Extra how much I'm paying? 4 rupee from 4 rupee per share you're paying from your pocket. Is it a gain for you? Loss for you. So I'm paying 4 rupees over and above what I've received. So it is a loss for me. Loss is nominal account. Debit all expensive losses. To increase loss, we have to give a debit. To increase loss, we have to give a debit. And this is what I'm creating a new liability. This much 560 I have to pay in future. When the buyback date comes, on that day I have to make the payment. So anything that I have to pay in future is liability. To increase liability, credit. Any problem in this? This is called as a due entry. This is called as a due entry. Online people, any problem with the due entry?
No, sir.
Now, you have to pass the entry for keeping your capital intact. For that, which method you're opting first? Sir, first, preference share capital. For balance amount, we'll transfer the money from CRR to general reserve to CRR. General reserve to CRR. So now, entry for preference share capital. Bank account debit to 12% preference share capital. How much shares are you issuing? 25,000 into 10. 25,000 into 10. How much it is? 2,50,000. Now my question goes to all of you. Your capital got reduced by how much? 4 lakh. Don't tell me 560. 560 is the amount including premium. Section 68 says that capital before and after buyback should be equal. So how much is capital reducing here? Only 4 lakh and not 560. So out of 4 lakh, your capital is reinstated to the extent of 250. How much is further shortfall? 1,50,000 is further shortfall, which will transfer from your reserve to your CRR. So as of now in this question, I'm going to use only free reserve and not SPR. But in exam, you can use SPR also. So my third entry is, yes. General reserve is my free reserve. So general reserve account debit. How much? 4 lakh is the capital to be reinstated. In that 250 is being reinstated in form of preference share capital. So the shortfall is how much? 1,60,000 rupees I am transferring to 50. Okay. Why are you scolding for that? Okay, 150. Now okay. To CRR. 1,50,000 rupees. So now capital 4 lakh reduced. Increase by 250 first, increase by 150 later. So capital is now intact. Now can I go and do the repayment? Yes. So what is the fourth entry? Equity share buyback account debit. How much? 5,60,000 to bank. How much? 5,60,000. So when premium came, little bit complication happened. Little bit. Now with this you cannot stop.
Premium.
Premium is what? Loss, nominal account, and all the nominal accounts at the end of the year should be closed by passing a closing entry. Now, this premium is a loss. Can I transfer this to statement of P&L directly, or can I knock off from the security premium account?
Can be.
Now for that, I will take you to section 52. Please go through section 52 properly, literally means properly, and tell me, can I use security premium? Can I use security premium for the purpose of writing off the loss on buyback, loss on premium of buyback?
No, sir. No, sir. Only preferential.
If you look at the point number E, 2E, it talks about that the premium can be used for the purchase of own share, purchase of own share. Now here two interpretations are coming by the law people. Some law people says that when they say that it can be purchased, that is the security premium can be used for the purchase of own share, that is buyback. Some people interpret that this is only towards face value. The extra premium that I'm paying, that they have not explicitly told. What have they told? Premium can be used for the purchase of its own share, that is buyback, it can be used. But to write off the premium that I'm giving on the buyback, to write off that, can I use it? It is not clear. Now, how people are arguing? People are saying that in the previous point D, you said that I can use this money, that is security premium, to provide. Provide means what? Write off premium payable on redemption of the preference. Explicit that I can use this for writing off the premium. Then why did you use that word here? So some people are interpreting that then premium is excluded. If explicitly law is not included, means it is excluded. Only I can use it for the purpose of transferring to CRR. This is one interpretation. Some people say that no. When they say buyback means any kind of buyback that is at par, at premium, anything can be used like that. There is a interpretation. Now this debate is there. This debate is there. We don't want to get into debate. Debate in law, you get into after you become a CA. If you want to fight with anybody, after you become CA, you go and fight. Now we have to do what ICA says. Because who's going to pass us? ICA. ICA is very clearly done one thing. The premium can be used for the purpose of write-off. Yes. Right or wrong, you have to go and fight with your law teacher. And every law teacher will have different opinion. So there also you will not get conclusion. I'm telling now itself. Are able to follow? I'm openly telling. It's a debate that is there, still there. Because the law, the language of the law is not clear. There's an ambiguity. Right? But we are not into law now. Okay. So now what will we do? We'll do what our Guru says. Who's our Guru? CA Institute ICAI. ICAI says very clearly that if there is any premium that you're paying on the buyback, you can use the premium, security premium, to write off the premium. So premium can be used for writing off premium. Premium can be used for writing off premium. Our game over. So what will be my next entry? Premium is currently in debit. Premium is currently in debit. To close, I'll give a credit. So fifth entry, people, 2 premium on buyback. 2 premium on buyback. How much it is? 1,60,000. So this is a loss which I'm trying to knock off against the security premium 1 lakh. So how much is there in the security premium? Only 1 lakh. So 1 lakh account debit, security premium. Security premium account debit 1 lakh. Where the premium is not sufficient, the remaining loss has to be taken and set off against your P&L. You'll take it to other expenses. So P&L, statement of P&L account debit 60,000 to premium on buyback. Little bit masala. Like that, konja innu vandu pathina entries koodum. Then the masala become too much big masala to remember. Any difficulty? Are you trying to buy hard everything?
No, sir.
Buy hard will not give any solution because the question, the way the language has been twisted, accordingly what will happen? The answer needs to be twisted. So basic buyback entries is going to be same, but investment entries, bonus shares entries, and issue of debenture entries, etc., that will be differing here and there. So according to language, you have to work out. Here in this entire thing, what you have to be very focused about is usage of SPR is very, very crucial here. Where how we are using that few complicated points are to be focused upon. Especially as Nishi had out, can I use SPR for the purpose of converting partly paid to fully paid? No. So like that, few places here and there, you could feel that confusion. For that, what is important? Revision is important. And before that, what is important? Understanding the law is important. So far, whatever we discussed in this, do you have any doubts? Online people, with so far that we
No,
discussed,
sir.
do you have any doubts?
Sir, in the chart,
Sir.
it's just an example also.
Come again.
In the chart.
In my chart, you're talking about?
The chart 2, that bonus share, that is just an example also. Like they're actually fully paying for equity shares, but that bonus share is an example. Yeah,
This one you're talking about, Amma. This is not example. This is very much based on this, and this practical questions are there in your ICA model.
Sir, equity shares are not fully paid. You are making that fully paid.
Correct.
You have given bonus share holder,
Two bonus to shareholder. In the entry, now this entry I took from your CA foundation. In your inter, what they should have done for the same concept. This is the same concept, guys. You have question based on this. The same concept what we studied in foundation is there in inter. In foundation, the same ICA said what? Free reserve to bonus to shareholder. Now in intermediate, same ICA is saying what? Free reserve to bonus share. Instead of bonus to shareholder, they're changing the name to bonus shares. But here also in intermediate, we have two entries. One is free reserve to bonus shares, and second is bonus share to equity share capital. We have this entry. Whatever entry I've given in your note here, 100% is applicable for your practical questions. I have not given anything out of syllabus. All the entries that I'm discussing here is 100% there in your syllabus. What is your doubt?
What are you actually making it as fully paid? Normal equity shares are not making it as fully paid.
Correct, you're right.
Then why that bonus name alone?
Because that is what the law says. No, I'm not creating in my name. Law says that whenever you're using free reserve for the purpose of giving, see, kana, apparently bonus, you didn't study properly. Bonus was not there in syllabus. Oh, okay. When you cleared, it was not there. See, okay. For that, you have to watch bonus share or a video, but I'll just tell you. See what happens. 10 rupee worth of share is there. 8 rupees paying, no. Remaining 2 rupees not paying, which means 10 rupee worth of share he got at 8 rupees. Remaining 2 rupees, who's bearing? Company is bearing. So when company is giving the funds from their side on behalf of the shareholders, this amounts to bonus share.
Not just fully paid, even if that.
So partly paid shares to be made into fully paid, and when you use the reserves of the company, this is also called as bonus issue of shares. Another bonus issue, pakka bonus issue means what? A shareholder holding 10,000 share, I am giving him 100 shares free of cost. This is the pakka bonus share only. But the concept, the law says that when the partly paid shares are converted to fully paid, no. And when this difference of 2 rupees, when you're using a reserve to be transferred to capital on behalf of the shareholders, this also amounts to bonus share. Who is saying this? The concept of bonus issue is saying this.
So instead of calling, we are just paying it from our.
Reserves, that is right. Online people, am I loud and clear? Okay, let's do a quick
Yes,
recap
sir.
one more time, guys. The reason of doing multiple recap is because as you know, you go ahead with the chapter, lot more points will get added, and this might be confusing. And moreover, whatever theory I've discussed from there, you will not get direct question per se, but from here the potential MCQ questions could be drafted. So you have to be very clear with what we are discussing. So what is the meaning of buyback? Buyback is repayment. Okay. What is the meaning of securities? Oh, she said rightly, sir. Buyback means what? Repayment. Repayment before the due date. Right. Sorry, my mistake. Buyback means what? Repayment. Repayment. Anything repayment before due date is buyback. Okay. Securities includes what? Equity shares, preference shares, debentures. All these three are securities. Now, when I talk about buyback of securities in your CA intermediate syllabus, our focus is only on buyback of equity shares only. Buyback of debentures and preference share is not there in your syllabus. Okay. What is the difference between redemption and buyback? Redemption means repayment of capital, but on the due date as agreed. It is planned repayment, where this is buyback means what? Unplanned means I'm paying before the due date. Preference share can be both buyback and redeem, but equity only can be buyback because we have not never committed any date for repayment to anybody. So equity shares can never be redeemed. It can be only bought back. Okay. So when the shares are bought back, you will get the physical share from the shareholders. What will you do with the share certificate? Within 7 days of completing the buyback procedures, you have to tare it. Okay. When I do the buyback, what is the impact of that on the capital? It reduces the capital. Can I do the buyback for the purpose of investment? So I wanted to invest. I don't know where to invest. So I'm investing in my own company in form of buyback. How? 10 rupee worth of share. I gave 14 rupees and purchased my own shares. That should not be the motto of buyback. Okay. Second, what are the objectives, advantage of buyback? It will increase the promoters holding. We saw example of 20 to 25. That promoters holding went from 20 to 25 just because of repayment of capital. So that is to increase the promoters holding so that he can develop the control, more control on the company than it was earlier. Second, this will help you to avoid hostile takeover. So first and the third point are almost linked. So why does the promoter wants to increase his stake? So that the hostile takeover could be avoided. What is hostile takeover? It is a takeover by the competitors unknowingly. That is without the company's knowledge. Gradually, slowly from the market, they'll start buying back in a position, in a way where after a point, the competitor's share in your company will be more than your own share. So what happens when your competitor shares in your company becomes more, they will kick you out and they will come and run the company. Am I right? So management is getting changed. The management is getting affected. So to ensure the effective management happens, to avoid hostile takeover, buyback is a very good option. And this will also lead to increasing earnings of per share. That is, earning per share is being increased. We saw example from 40 to 50. Okay. This will leave a positive impact in the stock market. This also we have discussed. So what is this? How does it have a positive impact on the stock market? When 40 rupee worth of share you're offering at 100 rupees, so automatically what? More people are attracted towards buying your shares of the company so that they can surrender the shares to you later. That is, after they purchase the share from the share market, they would want to sell it to you in the buyback scheme so that they can make a profit of 60 rupees. Second, when more people are coming and buying the shares of the company, the demand for the share increases, thereby the stock price in the share market also increases. This is because of the demand and supply concept. And third, when the company does the buyback, it gives a very positive message in the stock market that okay, this company's financials are very strong. The future, the future plans of the companies are very strong, and the financials are very much secured, and fundamentals of this company are very strong. That is a kind of message it goes to the public when the buyback has been done. And last reason is to improve the capital-based accounting ratios. Okay, for you to do the buyback, which are all the sections that you have to comply with under Companies Act? 68, 69, 70. Okay, done. If the provision of 68, 69, 70 are not complied with, who is affected? External liability holders is affected. So in example 2 and 3, we understood how their security is getting affected. Okay. Can I buy back the partly paid? Sorry, when can I buy back the partly paid equity shares? No. If it is partly paid, you have to make it fully paid. So for purpose of making it fully paid, how many options are there? For partly paid up shares, to make it fully paid up, there are two options. What is the first option? Make the call money due. So what is the entry for that? Equity share final call to equity share capital, and then bank to equity share final call. So this way, your partly paid up capital becomes now fully paid. This is one option. Second option is what? You can use your reserves. Which reserves? Only free reserves. Only free reserves and not SPR. For purpose of converting partly paid to fully paid. What is the entry? Free reserves account debit to bonus shares. And then bonus shares to equity share capital. So because of these two entry, now 8 rupee worth of capital becomes now 10 rupee. If you buy back the partly paid up equity shares, who is again getting affected? External liability holders. And for that also we saw the question. Wonderful. Now, once you buy back the shares, your capital is going to reduce. Correct? No? Because buyback will decrease the capital. But that decrease of capital will send a sense of fear to the minds of the external liability holders. To ensure that the external liability holders are not affected, Albin, what are we supposed to do? Keep the capital intact. To keep the capital intact, Section 68 is proposed how many options? Two options. First, you can issue preference share capital to keep the capital intact. Or second, you can transfer from security premium reserve and free reserve to CRR. So when I'm issuing the preference share capital, what is the entry? Bank account debit to 9% preference share capital, let's suppose. Sometime ICA will not pass the combined entry, they'll pass the individual entry. So what is the individual entry? Bank to preference share application and allotment. And then, very good. Preference share application allotment account debit to 9% preference share capital. Correct? Second, transfer the money from SPR free reserve to CRR. In some questions, what IC has done, they have not used SPR, they have used only general reserve, that is FR, despite SPR being available. And in some questions, they have used comfortably SPR. So who is allowing SPR to be utilized for the purpose of transferring to CRR? Only section 68 has given empowerment that for the purpose of section 68, SPR can be treated as free reserve to be transferred to CRR. Any problem here?
No, sir.
Online people, any problem so far?
No, sir.
Please tell me, what is the journal entry for the buyback of the shares? Equity share capital to equity share.
We share buyback.
This is at par. If it is at premium, then what is entry? Equity share capital account debit.
Premium on buyback.
Premium on buyback. Very good. To equity share buyback. This is called as what entry? Due entry. Very good. Now form has come. Next entry. Payment entry. Equity share buyback to bank. Same entry here. Equity share buyback to bank. But here extra entry will come for, yes, rightly said. Premium on buyback. SPR account debit. Statement of P&L account debit to premium on buyback. So now we have understood all the entries, what you call it, in groups here and there. So what you have to do in the upcoming class is to organize all this entry in a format so that you don't miss out on any entry. But individually, if I ask you, are you able to imagine this? Are you able to recollect this? Now, this you will not be able to recollect when in exam. Tell me how. You'll not be able to recollect. I'm telling you now itself. Because if you don't revise like this in regular intervals, in today's session itself, beginning, after break, before I'm ending the class, I did one study and 2 recalls I've done today itself. If I'm doing 2 recalls in the class itself, then imagine how important this will be. And because we are belonging to Gajani family, we have the highest chances of forgetting what we are studying. So you have to revise how many times? At least 10 times you have to revise. How? The same way. From the beginning, how I revised, no, same way you have to revise. All the entries you have to write in. This is how you have to revise at least 4 times in next 15 days. 4 times in next 15 days. Remaining part of the revision I'll take care when I do the practical question. That time multiple times we'll do revision. That apart, 4 times should be your self-revision. Okay, not okay? Chalo. Can we wind up?
Yes, sir.
So guys, that's all from my side for this new chapter today. I'll see you all tomorrow morning, 10 a.m. sharp. Correct? No? Yes. Until then. Bye-bye. See you. Take care. Let me enjoy my peace. Thank you.